Hello and namaskar viewers. I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ. The show is brought to you by Sai CPA Services, a full-fledged, complete professional accounting firm with multiple locations in the state of New Jersey. But they can assist you with any tax matters, corporate or personal tax matters. They can assist you wherever you are in the United States of America. They can be reached at 908-888-8900 or visit their website, which is saicpaservices.com. This is the show brings you all that you really need to know when it comes to taxes. And Sai CPA Services believes in doing taxes right. Whatever that taxes needs to be paid must be paid. But on top of that, whatever deductions that you're entitled to, you must get those deductions. And Sai CPA Services is the one that helps you to get all the deductions that you really need to get. They're knowledgeable, on-hand, experienced CPAs in the staff. They will assist you and making sure that whatever deduction you are entitled to, you get that, so that way your tax liability is reduced. Remember, taxes that you must pay, but how you can save on taxes, that's what Sai CPA Service is all about. Once again, they can be reached at 908-888-8900 or saicpaservices.com. With that note, I'd like to welcome Mr. AJ Kumar of Sai CPA Services with over 25 years of experience in this tax and accounting field. He's a CPA, CBA, and MBA with Sai CPA Services, and brings a wealth of knowledge and experience when it comes to taxes, accounting, and businesses. AJ, welcome to the show.
Thank you, Sanjeevji, and thank you for the kind introduction.
You're most very welcome, and because I know Sai CPA Services all these years, and I know their services, and I know that how you and your staff have built a reputation so high, helping out clients, multiple clients in a business category, in a personal category throughout USA. And I know you're going to get busy from next year, just a couple of weeks away, and you're going to have a busy schedule as a CPA.
Absolutely. Season is always busier than the normal times, and it generally starts from 1st January onwards. We'll have W-9, 1099s, W-2s. A lot of work happens before the tax filing actually starts.
Yes, absolutely. And by end of January, a month from now, you're going to be really, really busy, drinking coffee or tea every 10 minutes to get the things done. But anyway, folks, today we're going to talk about what's in the store for you when it comes to tax benefits, 2025 tax guidelines when it comes to deductions and the credits. Mind you, there have been a few changes, a few significant changes as part of President Donald Trump's big, beautiful bill known as BBL. So AJ is going to give us a lot more information that you and us, we really need to know when it comes to 2025 taxes, which we will start filing come end of January. AJ, so let's start with standard deductions, what has changed, and the credits and everything else it follows.
Absolutely, Sanjeev, rightly put. So we have some changes every year anyway. The standard deduction, itemized deduction, the limits, income threshold changes every year. But this year is different. Not only we have this OBB1, one big beautiful bill they call it, we have a lot of new changes, new provisions. So you need to know what can benefit you. The onus remains on you to take the maximum tax benefit. If you don't claim a benefit, the system, IRS wouldn't come back to you, tell you that you missed this benefit. You should take this benefit. Today we are talking about deductions and tax credit. When it comes to deduction, everybody is familiar with standard deduction. Now they have new limits for the standard deductions under OBB, one big beautiful bill. For single person, the standard deduction is $15,750. For married filing joint person, the standard deduction is $31,500, much higher than the last year. They have a new deduction added this year under this one big beautiful bill again, which was not there last year. Seniors, if you are over 65 and have income below certain thresholds, $75,000 per person, married filing joint, $150,000, you get additional $6,000 per person of deductions over and above the standard deduction. Remember, you have the right to claim itemized deductions if your itemized deductions are higher than standard deduction. So you can pick and choose. You can try to compute your itemized deduction, and if your itemized deductions are lower than standard deduction, use standard deduction. If itemized deductions are higher than standard deduction, then use itemized deduction, whichever gives you the more benefit.
Okay. And what about the credits? That's a standard deduction. And as you said, it changes every year. So obviously there is a change for these shares also. What about the credits, starting with the medical expenses?
So medical expense is still a deduction, Sanjeev ji. So medical expense is part of itemized deduction. So if you talk about medical expense first, before we get into credit, so there are several itemized deductions. Say, for example, medical expense is there, then you have SOLT deduction, state and local tax deduction, which is now increased to up to $40,000, which used to be capped at $10,000. There are income limits. I mean, if you are making more than $500,000, then it goes down to $10,000. It phases out to $10,000. But for all practical purpose, now the 10,000 cap has been increased to 40,000. So it should save you a lot of money with the itemized deduction if you qualify.
That's a significant increase.
It is.
From
It is very,
10,000 to
very good. I
40,000.
mean,
Yeah.
especially if you own a home. What's included in SOLT is the state taxes, the local taxes, the property taxes, and the sum total of it is capped now to $40,000. Especially for people who are making less than $500,000, this one change alone can save you thousands of dollars.
Wow.
If you own home.
Absolutely.
Then we have charitable contribution, some gambling losses, miscellaneous deduction. All these deductions goes on Schedule A. We call it itemized deduction. Mortgage interest, medical expenses, property tax, state and local tax, charitable contribution. Just remember, medical expenses are limited to more than 7.5%. Your medical expenses have to be in excess of 7.5% of your AGI. So if your AGI is $100,000, your medical expense is $10,000, only $2,500 count in excess of 7.5%. So you just have to be cognizant about the rules, the regulation around it. At the end of the day, Sanjeev ji, the idea is you calculate your itemized deduction, and if your itemized deduction is higher than the standard deduction, then you should claim itemized deduction to get the maximum tax benefit.
All right, good. It's still deduction. We haven't got to credit
Right.
part yet, so it's still deductions. I mistakenly says, a credit part, but it's still deduction. What about retirement contribution, HSA, and education deduction?
They are also deduction, rightly put, Sanjeev ji. So they are not part of standard deduction or itemized deduction. It's a separate concept. You can use either of standard or itemized, one of them, but you can definitely use all these FSA contribution. You can also use IRA contribution, SCP contribution if you have a small business. So there are a lot of other retirement-based contributions that can lower your taxable income as long as you have a qualified plan, and there are a lot of them. Depending on your situation, if you have a business, how much money you are making, and depending on your choice, do you want to contribute to pre-tax, post-tax? So contribution to a retirement plan can potentially reduce your taxable income over and above the itemized or standard deduction.
Okay, interesting. So now, having touched base upon this, standardized deduction, let's look into the credits. Earned income credit, child tax credit. Let's have information on that part.
Absolutely. So let's understand the difference first one more time. So deductions reduces the taxable income, while credit reduces the actual tax liability.
Correct.
So take an example. If your taxable income is $100,000, and let's say you're paying $20,000 in taxes based on 20% tax rate. So if you have a $10,000 of deduction, it reduces your taxable income from 100 to 90,000. So you pay 20%, 18,000 in taxes as opposed to 20,000. But if you have the same 10,000 of credit, it reduces your tax liability from 20,000 to 10,000. So if you have an option, and in many cases you truly don't, but if you have an option, you want to choose the credit over the deduction. Now let's talk about what are the main credit. You rightly put, Sanjeev ji, child tax credit is one of the most common one. And again, with one big beautiful bill, there are a lot of changes to it. Now the child tax credit can be $2,200, out of which $1,700 is refundable credit. So let's take another step and let's define what's refundable versus non-refundable when it comes to tax credit. So the tax credit again reduces the tax liability. In the sense, whatever you tax you owe, it reduces the taxes dollar for dollar as opposed to reducing the taxable income. Now, some of these credits are refundable, meaning let's say if you owed $1,000 to the government and you have a credit of $2,000, this credit is limited to $1,000, meaning the credit is limited to the extent of the tax liability. It's not refundable. For example, child tax credit can be up to $2,200 per child, per qualified child, but only $1,700 is refundable. If your total tax liability is $1,000, will give you $700 back, even though your credit is $2,200. If your tax liability is $3,000, for child tax credit will give you the benefit of $2,200, so now you owe $800.
Okay.
So child tax credit, then you have child care.
Child and
Dependent
dependent
care,
credit, yes.
flexible spending account. If you have an FSA, like HSA is healthcare spending account, you have FSA where you can use child care, dependent care tax credit. That can be up to $1,200 depending on, or 12% or 20% of what you're spending. $1,200 or 20% of what you spend for the dependent care. Then you have earned income tax credit.
Correct.
Earned income tax credit is a misnomer. Earned income tax credit is given to people where the income is not high enough, where their earning is not high enough, they qualify for this earned income tax credit. Then you have American opportunity tax credit. Again, they are all credits. They reduces your tax liability dollar for dollar. So American opportunity tax credit could be up to $2,500 per child for the first 4 years of their education, college education. Then after the American opportunity tax credit, you see the lifetime learning credit. Lifetime learning credit is for older folks after the schooling if they are still learning something new.
Up to $3,000.
Up to $2,000.
$2,000.
So it's $2,000 per person. Just remember, for the same child, you cannot claim this both credit,
Yes,
American
absolutely.
opportunity tax credit as well as the lifetime learning credit is after the post secondary education, after the first 4 years of education. So for the same child you cannot claim both. But if you have, let's say, 2 children, for one you can potentially qualify for American opportunity tax credit. For the second one you can qualify for lifetime learning credit. You can
Interesting.
yourself qualify for lifetime learning credit. So there is no age limit on lifetime learning credit.
Absolutely.
There are income limits though. You have to be careful. Depending on how much income you make, you may not get the same benefit or the full benefit in some cases.
Okay, very well said. This credit explanation is very helpful. So, maybe it's safe to say that standard deduction are the rights as a taxpayer that you get those standard deduction. But the credits, various credits, it's a privilege to have that, so that way your tax liability reduces dollar by dollar, correct?
Absolutely. And the way I want our viewers to see, based on the current government system, they are both privileges. They are both are benefits given by the government. And as much as right now we know 37% is the highest income tax rate, and 37% plus the state tax rate is absurd high. I mean, half the income is going into taxes. But believe me when I say it, currently the tax rate that we have in this country are one of the lowest one.
Okay. All right, very well said. Well, yeah, with that note, we're going to take a short break. When we come back, we're going to continue this conversation on the deductions and expenses and the credits and everything. A lot more very valuable information coming your way right after these messages. Welcome back to the second half of the Tax Talk with AJ. As you know, the show is brought to you by Sai CPA Services, a professional accounting firm located in state of New Jersey, can help you with any tax matters, personal or corporate tax matters. On top of that, in case if you are in the IRS tax audit, they can also assist you with IRS tax audit matter. So give them a call at 908-888-8900 or SaiCPAservices.com, and they can also assist you with virtual CEO, CFO, and the bookkeeper in your business, so that way you can focus on business. Today's topic is tax deductions and credits and all that you need to know for the year 2025. That means 2025 is going to end very soon, and now next year in 2026 we're going to be filing a tax return for the year 2025. In the first half of the show, AJ ran down all the deductions and credit information. Now we're going to go into a little bit of more deeper and to get you more information when it comes to deductions and everything. So AJ, my question is, what are the common deductions for the year 2025?
So a lot of them. It depends on your situation. Individuals have a different situation. Businesses have a different situation.
This is itemized deductions. Let's talk
Absolutely.
about.
So for individuals, it's specific to itemized deduction. From the chart top down, you have medical expenses, you have mortgage interest, you have property tax, you have estate tax, you have charitable contribution, you have miscellaneous deduction, you have gambling income losses. They're all falls part of the itemized deduction for individuals.
Okay, but I guess there are some normal ones and there are some specific ones, right? Now, because not one deduction or one category
100%.
applies to everybody.
Absolutely. So if you are not a homeowner, more than likely you will be using a standard deduction, not the itemized deduction. If you have a health insurance where the insurance is provided by your employer for a W-2 person, you probably won't have significant medical expenses to claim anything. Remember, medical expenses have to be in excess of 7.5% of your AGI.
Yep.
So a lot of people don't have high enough medical expenses. So you have to look at your situation. Your point is well taken, Sanjeevji. Not everything applies to everybody.
All right, so now we talked about that personal deductions. Let's talk about business. What are the common deductions for businesses for the year 2025?
Absolutely. So it depends on business to business, but in general, you have cost of goods sold. Whatever you are selling, you are buying it first. So there is some money going out. If you are a consulting service business, then you have employees probably. You have staff, salaries, payroll taxes. You have an office, probably you have rent, lease, or property tax expenses around it. If it's a triple net, you may have other expenses around it. Then you have travel expenses. Then you have meal expenses. Remember, meal expenses are claimed only 50%. The theory is when you are going out with a client, only the client portion of the meal is deductible, and it has to be regular and usual for your type of business. You can't say generally I go to Taco Bell, but for this client I went to this fancy restaurant and it costed me $500 for the lunch. That's not going to fly. So it has to be usual, it has to be regular in your type of business. Then you have a lot of other expenses: professional fees, legal fees, business startup cost, machinery, R&D. So depending on your type of business, the example I generally take for a grocery store owner, even the grocery, buying the grocery is a business expense. For me, TV or couch is a business expense because I have a TV, I have a couch in my office. So depending on your situation, you have to see, is this expense a usual, normal, regular expense for this type of business? Most accounting firms will have a table, a couch, or some chairs, and those expenses are normal and usual for this type of business.
Interesting. All right, talk about businesses. What exactly is qualified business income deduction?
I'm glad you brought it up. I almost missed it. It's a beautiful thing. They call it QBI. It came around in 2017, Tax Cut and Job Act. The idea was the first 20% profit from an LLC or an S Corp, it has to be a flow-through entity, not for C Corps, is not taxed anymore. So this provision was about to sunset next year. But now they have made it permanent. So with QBI, a qualified business income deduction, first 20% of your profit from an S Corp or LLC is tax-free. That's QBI for you.
Interesting, very interesting. Now let's just go into the personal tax deduction matter, because we covered the personal and the business. So now the question I have is for you: what is the taxpayer should really do when it comes to planning for 2025 taxes on a personal basis?
A lot of things. So right now you have some time off, hopefully. Find out all the receipts, find out the donation receipt, find out the medical expense receipt, try to create a profile for yourself, know how much income you are going to have, see where else you can invest. Do you qualify for IRA? Does your business allows you to invest into 401k? Do you still have the option to maximize 401k through your job? If you have a small business, a side hustle, see how much the net income you are going to get. Try to create a P&L, profit and loss statement for your small business to identify what expenses are there. Are there some expenses that you can pull forward? So let's say the rent is supposed to be paid on 5th January. Can you pay it on 25th December? So you can claim it this year. Depending on your income, the idea here is try to do the paperwork, try to find the receipts, try to reconcile your income, expenses, and then make the decision what makes sense in your case. Is it a good idea for you to pull forward some of the expenses, meaning pay some of the expenses that are typically going to be paid in January, in December, or does it make sense for you to push some of these expenses to January, vice versa? Remember, there are dates around it. Say, for example, 401k contribution must be done prior to December 31st. SEP has the deadline for March 15th. Your IRA has the deadline for April 15th. So be cognizant of the timeline while you're making these decisions. That's why it's important to have that conversation, that planning done right now.
All right. Does it mean the same for business owners also while they are planning 2025 taxes?
A similar concept. It goes a little bit hairy for the small business owners. They also have to see how they performed in last couple of years. Especially if you have loan, if it's a leveraged business, the bank wants to see continuous growth in the business. You have to be careful. Last year you showed a profit of 80,000. Do you want to show 90,000 this year? In order to show 90,000 this year, do you need to pull expenses from the next year, or do you need to push expenses to the next year? So with business owner, it gets a little bit more complicated. You have to be looking at your personal tax, you have to be looking at your business tax, and you have to be showing continuous growth for your business. It also depends what type of business you have. Is it flow through or a C corp type of business where the taxes are paid at the business level? If it's a C corporation, be cognizant of the estimated tax payments as well. If you expect to owe more than $1,000, you're expected to pay some estimated taxes throughout the year. Don't assume that I'll pay the taxes on April 15th when I file the taxes. In that case, there will be some interest and penalties around it. If you owe money, you're expected to pay during the year. The last deadline for the estimated tax filing for this year is January 15th. I mean, we talked about a lot of deadlines, December 31st for the 401k, January 15th for the fourth quarter's estimated tax payment. Then we have March 15th,
March 15th.
for the business tax filing. SCP, we have January 31st for the
Yeah.
1099 filing. So for business owners, a little bit hairy, a little bit complicated, and you have to know a lot of deadlines and a lot of limits around it.
Okay, all right. Quickly, you mentioned meal expenses in the business category, and that was enough information you gave. What about vehicle expenses? Is vehicle expenses deductible for businesses?
Absolutely. If your vehicle is regular, usual for your type of business, and you are using it for business purpose, it's allowed. I mean, you can't really say, I'm buying a Ferrari or something else, and very, very expensive car, and I'm running a grocery store. I mean, not that people don't have it, but is it really needed for this type of business? I mean, how is this vehicle adding value to this business? If you have a truck, it makes sense for a grocery store. If you have a regular car for an accountant, it makes sense. So you have to be cognizant about it, that you are not misusing the deduction.
All right. So as we are just winding down, the taxes matter for the personal and the businesses. Quickly, can you just touch base upon the common errors that taxpayers make before the tax season starts? That means between now and December 31st, what can they do to save a tax liability?
Absolutely. Please check, though. If there's one thing you can do, please check your pay stub. Make sure your name is spelled correctly. Make sure your social security number is there and it's right. and make sure you know how much income you are going to have. Then accordingly, see if you can maximize the 401k plan, FSA if the business is offering, or HSA. Any tax benefit that you have through your job, you need to maximize those benefits. This is the last opportunity. Your last paycheck will be around last week of December, December 31st probably. So if you don't make the changes now, this week, you wouldn't qualify for that change. So if there's one thing you can do as an individual, try to review your paycheck. As a small business owner, please try to review how much profit you made this year so far, so you can try to pay some bills before the end of the year or delay some payments. So knowing information is the power here.
Okay. In this, in today's show, we have covered mainly federal-based deductions and the standard deductions and expenses and the credits and everything. Anything that you can add when it comes to state of New Jersey law, which might be a little different than a federal
So
or something?
generally speaking, state of New Jersey will take the same benefits as the federal government. There are certain benefits that the state of New Jersey does not allow. So if you have a passive activity, the losses are suspended, not allowed. Charitable contribution has a benefit with the federal government. The state of New Jersey does not allow benefits for the charitable contribution. So there's most benefits for all practical purpose. The state of New Jersey allows follow the similar set of rules as the federal government. There are certain benefits the state system doesn't allow it.
Okay, all right. Now, when it comes to taxes, obviously, there are people who will always complain about the taxes, that not enough deduction, not enough credits and everything. My question to you is that will tax law change after year 2025? These are the, these are the expenses that you ran through for this year. But will it change after 2025?
It's very difficult to change the tax laws. So one big beautiful bill has set the tax laws for the next 4 years. There may be tinkering around it, there may be fine tuning around it. We are not expecting a large tax bill until the next government comes. So when the last time President Trump came in power in 2017, at that time we had seen a major change. After that, we did not see the change in the next government cycle. In 2025, we see the changes again, but we are not expecting major changes to happen in next couple of years.
Okay, next couple of years.
Until this government.
You can't
changes.
make changes every year, right?
It's very difficult
it's
to
very
make changes.
difficult.
You can do the
Obviously,
fine tuning around
Yeah,
it,
yeah.
but making the changes of the OBBA type of
Yeah.
level is extremely time consuming.
minor changes are going to be
Absolutely,
there,
absolutely.
There will be maybe $500 or $1,000 more in a standard deduction
Right.
and stuff
There
like
may
that.
be more explanation that we said this thing, but we meant this thing
Yeah.
type of changes. But the major changes are not expected.
Yeah, because there is a tremendous amount of work involved and team force and everything in different departments, and they have to get the
Absolutely.
paperwork right and everything. So it won't change anyway, folks. So be very, very careful when you start planning for your taxes to file for the year 2025. Quickly, AJ, can you add a note or two on IRS tax audit in case if they have gotten IRS tax audit, what should they do for the next year?
Absolutely. So IRS is auditing a lot of people now, and so is New Jersey. If you get the audit letter, the last thing you want is to ignore it.
Okay.
Please make sure you bring it to your CPA, bring it to somebody's attention, make a quick call to the letter given in the notice, and make sure you respond to it. A lot of these notices are computer-generated notices. They are just in error. You can explain it, and the notice goes away. We do it every day. We see it every day. But make sure you're not ignoring the notice.
That's right.
Please.
Don't ignore it. That's really important. With that note, we come to the end of this week's episode, the Tax Talk with AJ. AJ, we'd like to say thank you so very much
Absolutely. Thank
for
you
your
so much.
guidance and information that everyone really needs to know when it comes to tax deductions and everything else for the year 2025. Until we meet again, same place, same time. First of all, wishing you happy holidays and also tax-free days ahead. So long.
Thank you.
Hello and namaskar viewers. I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ. The show is sponsored by Sai CPA Services, a professional accounting firm located in the state of New Jersey. Multiple locations, but they can assist you no matter where you are in the state for any tax matters, any bookkeeping matters, any payroll matters, because their on-hand knowledgeable CPAs and experienced staff will help you with any business matter. You can give them a call at 908-888-8900 or visit their website, saicpaservices.com. With that note, I'd like to welcome Mr. AJ Kumar of Sai CPA Services with over 25 years of experience, and he holds degrees like CPA, CVA, and MBA. He brings in a wealth of knowledge and experience to this show. AJ, welcome to the show.
Thank you, Sanjeev ji.
Good to have
so
you.
with MBA, CPA, and CVA means business valuation licenses for our viewers, and then Series 7 and Series 66 wealth planning licenses as well. Some people believe they are harder to get than the CPA license,
Yes.
actually.
Really. Any more degrees that you plan to
No, I'm
add
not sure.
in
I'm not sure.
2026?
Life is all about learning.
Yeah.
So the good thing is, just because we have the MBA in finance, we have the wealth planning license, business valuation license, we can look at a small business from a holistic view. If you go to a CPA who doesn't have the MBA, CVA, wealth planning licenses, you more than likely find somebody who is just doing the data entry in a software and spitting out the tax. This is what you owe. But why? I'm not even making that much money. No. This is what you owe. This is what you have to pay to the government. What can I do to reduce this tax? We don't know, because they don't have the Series 7 and Series 66 licenses to decide where you can invest money in a qualified plan to reduce your taxable income.
Very good. All right. So since you have these 3 degrees, Ajay ji, kabhi aapne aisa socha hai, did it ever occur to you that at the end of December, at the end of the year, you sit down and you say, okay, I'm CPA for this many years. Let's see how much money that degree brought in. I'm CVA for this many years. Let's see how much money that brought in. And I'm MBA for this many years. Let's see how much money it brings in. And then you add up the number. You must be coming to a few millions, right?
I'm not sure if you can quantify how much money each degree is bringing.
I'm just kidding.
But I tell you, I have been here in this country since 96. And since 99, I write my yearly diary. Every year I'll write my monthly goal, quarterly goals, yearly goals, family goal, social goal, financial goals, learning goals. So and it's all black and white, handwritten in the diary. And then I'll check it every quarter, every 6 months, what I'm achieving, what I'm not achieving, so painfully. Each degree, each part of the education brings some value to your life.
Yes, absolutely.
Directly or indirectly.
Yes, absolutely. So you are the goalkeeper now that we have learned. You are the goalkeeper. Anyway, so let's continue our conversation with goalkeeper AJ. I mean, as you know, I'm just joking. AJ with CPA, CBA, and MBA, and like I say, wealth of knowledge and experience that he brings in the show to guide us and to inform us. All right, so we are in month of December. We're all waiting for New Year to come in, 2026, but at the same time, you also need to wrap up this month and the year, look at the taxes and how much income you're going to make and whatnot and everything. All right, so I'm going to talk about that part, that what you really need to do before the end of the year. But now let's talk about very important. You get some tax documents. You get W-2s, you get 1099s. Now let's talk about 1099. Why 1099 and what is 1099?
Absolutely, Sanjeev. 1099 is an information filing. A 1099 document is similar to a W-2 document. If you are working, if you have a job, you get something called a W-2 at the end of the year, which summarize how much money you got, how much social security you paid, how much income tax you paid, which state you worked in. All that is summarized in a W-2. Similarly, if you are a contractor, if you are not an employee, but worked as a subcontractor, freelancer, you get a document called 1099. 1099 could be of many different types. Say, for example, there is something called 1099 NEC, non-employee compensation. So an accountant, payment to an accountant could be considered as a 1099 NEC payment. Payment to your website designer, anybody who you paid more than $600 in total throughout the year, who is not your employee, who is a subcontractor or freelancer, that person typically get a 1099 NEC. A different type of 1099 is called 1099 miscellaneous, MISC, 1099 miscellaneous. All the rental payment, all the royalty payments goes through 1099 miscellaneous. So if you have a small business, you are making the payments to your landlord, you are expected to issue a 1099 miscellaneous to the landlord. So make sure all these miscellaneous payments, rent, royalties are included in 1099 miscellaneous. If you are paying interest because you borrowed money for your small business, you are supposed to issue a 1099 interest. There is 1099 dividend that the company issues if they are issuing dividend. 1099R means retirement. If at the end of the year you get a retirement account, if you take money out of your Roth IRA, if you take money out of your traditional IRA, SCP plan, your retirement account, this company, the brokerage, will issue a 1099R to you. You have 1099S. If you are selling an investment property, selling a home, more than likely the attorney, the closing attorney, will issue a 1099S to you. So there are different type of 1099s. It depends on the situation, depends on the scenario, what type of 1099 needs to be issued. The idea here is somebody made a tax deductible payment to someone else. It's not through W-2, not an employee. So how do we track this payment? How do we know that you are claiming this payment as an expense on your business tax return? How do we make sure the other person is claiming this as an income on their tax return?
Absolutely. Now, let's touch base upon two other categories. One is 1099B, as in boy. That's for the brokerage transactions, correct? And now, because the Zelle and Venmo and everything has become so popular, there's a 1099K.
1099K has always been there. It's issued by the merchant centers when you have your business accepting credit card, accepting Zelle payment, Venmo payment. Generally speaking, these merchant centers will issue a 1099K to you. And the idea here is, it doesn't matter what type of 1099 you're getting. A copy of this 1099 goes to IRS. A copy of this 1099 goes to the state. And the payer is the one who is going to issue the 1099. It doesn't matter what type of 1099 you have. Now, this payer, by issuing this 1099, wants to tell the government, this is a legitimate business expense for me. Remember, it's a business expense. So if you have a cleaning lady at your home, you have no business, you have cleaning lady coming to your home, you don't issue a 1099. 1099 is issued for business expenses with an intent to claim that that expense as a tax deductible expense. The idea is now the IRS know that this person made so much payment, this much payment to this person. Now this person wants to claim it as a tax deduction. Now we know this social security number received the money. So they must include it on their tax return as taxable income.
All right, so 1099 basically is someone's expense and the other person's income.
Absolutely. So a lot of times we are asked, what if I don't have the receipt for this expense? What if I paid in cash? What can I do now? So if you paid in cash, you don't really have a proof that you made this payment. In those cases, it's more important to issue the 1099 so the government knows there is no dispute around it. Hey, I issued a 1099. This person accepted the 1099. This person has the 1099. I'm claiming it as an expense, so this person can pay the right taxes.
Okay. All right. So that's a 1099. All right. So these are the categories that you explained to us. The categories 1099. Once the person gets 1099, what should be done with that 1099?
100%. So once you receive the 1099, it must be reported on your tax return. So a lot of time people ask us how much is the minimum income that forces me, that requires me to file the tax return. And you will see a lot of Google articles, a lot of internet articles that will talk about if your income is less than $14,000, you don't need to pay, you don't need to file the taxes. That's true for the W-2 job. If you are a single filer, just because the standard deduction is $14,000, that's why the concept, the misconception, this perception, this theory comes that if you are making $14,000 as a single filer, you don't have to pay the tax. But that's for the W-2 only. If you are making more than $400 as a subcontractor, as a freelancer, and remember, the 1099 is issued if you made more than $600. So if you got the 1099, it's mandatory, it's compulsory for you to file the taxes. And how do you file the taxes now? You need to include it on your Schedule C. Even if the 1099 is coming to your own name, it's considered as self-employed income. And Schedule C, C as in Charlie, is where you report the income, the 1099 amount. You have the right to claim certain expenses. Let's say, going back to the cleaning example, if you have a cleaning job and you're cleaning office spaces, you made $10,000. This $10,000 becomes your income. All the expenses, the supply, the travel, and you may have other laborers, other people working for you, all that become expense against this $10,000. So you don't pay tax on $10,000. You pay tax on $10,000, the 1099 amount, minus all the expenses that you can claim against it. The net income is what you pay taxes on.
Okay, very well said. Thank you so very much for that information. With that note, we're going to take a short break. When we come back, we're going to discuss that, once a 1099 is reported on the tax return, that's fine. But what are the deadlines for the 1099? That's all you should know. That's coming up right after this message. Stay with us. Welcome back to the second half of the Tax Talk with AJ. This is the show brings you all the latest and the greatest you need to know when it comes to taxes. What are the changes for taxes? What you should really be doing when you file taxes? What are the things that you really need to be taking care before you file taxes? There are a lot of things involved, and that's what AJ of Sai CPA Services brings in this show, all the information and the guidance that you really need to know. But if you get confused somewhere and you need more information, you need to reach out to Sai CPA Services by calling 908-888-8900 or visit their website saicpaservices.com. Before the break, AJ told us the various categories of 1099 and what exactly is 1099. Someone's income becomes someone's expense, so on and so forth. But now, let's touch base upon the deadlines for this 1099 because it varies and you really need to know about that because it is a bit different than W-2s, so 1099 deadlines.
So IRS has this 1099 deadline for January 31st, Sanjeevji. So the way the concept works for the prior year, so by January 31st, 2026, we are supposed to reconcile for the year 2025 and issue a 1099 to all the subcontractors, all the freelancers, the landlord, somebody who we paid the royalty out to, somebody who we paid the interest as a business. Again, just to remind our viewers, 1099s are issued to legitimize expenses as part of the business. If you don't have a business, if you are making this payment from your home, you are not required to issue a 1099. You don't have any obligation to issue a 1099. So 1099 deadline is January 31st. If you can't file by January 31st, please try to file ASAP. The penalties are very high, depending the type of 1099, and the penalties can be duplicated because the IRS did not get a copy, the recipient did not get a copy. So all these penalties get multiplied. A typical business can have 10, 20 more 1099s. So a small penalty becomes very, very large amount, especially if it can be proven that there is an intentional disregard to the law. So please, and how do you prove that there's an intentional disregard to the law? Because you did not issue any 1099. What it means is, if you were supposed to issue 10 1099s, 15 1099s, and you issued 7, 10, 12, you issued some 1099s. You could not issue everything. We can understand the information was not available to you. But if you did not issue any 1099, that's not seen positively. That's not taken kindly.
Okay. What are the common mistakes that you really want to address upon to the viewers for when it comes to 1099? What should really they do to verify it's all correct?
Absolutely. So please get a copy of the W-9, signed copy of the W-9 from the vendor from this freelancer, from the person who you are making the payment. Before making the payment, you cannot come back to IRS and say this person is not giving me his social security number or they are not giving me their EIN number. That's not acceptable. Before you make the payment, get a copy of their signed W-9. Make sure if it's a business, it clearly specifies if it's an LLC, S Corp, C Corp partnership. You don't have to issue a 1099 to a C corporation or S corporation unless they are an attorney. All attorneys must get the 1099. But if it's a C corporation or S corporation, meaning INC, you don't have an obligation to issue a 1099 to them. If it's an individual, make sure the spellings of the last name are right. IRS system will check the last name with the social security number. Make sure you are not making these payments to an ITIN number, ITIN number. All these payments needs to be issued the social security number, unless if they have the ITIN number, more than likely they don't have the work permit to work in this country. The situation is getting very, very strict when it comes to immigration. Please be extra careful who you hire and if they have the right documents or not.
Okay. All right, good. Now, with the 1099, is there a way that they can save some taxes on a 1099 and the income to be reported or something like that?
Absolutely, there are several ways to save taxes when it comes to 1099. So, if you compare with W-2, if you make $100,000 on W-2, you cannot claim the travel, uniform, meals and entertainment, home office, laptop. All these expenses cannot be claimed as deduction on your W-2. But if you have the same amount on 1099, your home office expense, your travel expense, your gas expense, your client entertainment expense, your uniform expense, your laptop expense, your phone expense, your internet expense, all those expenses, as long as they're meant for business, because you're self-employed now, can be claimed against this income, and you pay taxes on the net leftover income, not on the gross income. Even on the net leftover income, you have a lot of options to invest money into your own qualified plan. The beautiful thing is SEP, Simplified Employee Pension Plan, where you can claim up to 20% of your net income from a Schedule C from self-employed, or if it's an S corporation, if you're running your own payroll, you can go up to 25% of your own payroll. So there are rules around it. Maximum is $70,000 for this year, but it's a significant amount. It's a large amount, and the money is going into your own retirement account, more like a traditional IRA. You can compare it with, and it further reduces your taxable income.
Okay, all right. 1099 for a foreign contractor. Do foreign contractor get 1099 or what happens?
It's not 1099. The comparable form is 1042, and not all foreign payments require 1042. There is a form W8BEN that you need these foreign contractors to fill up to claim if they have any nexus with the country or not. If they have any nexus, then you have an obligation to file 1042. There may be some income tax withholding around it, depending on which country you are making the payments to. It could be as low as 5% or as high as 40%. In India, it's either 15% or 30% generally, depending on your income tax bracket, depending on few factors. But the idea here is when you are making the foreign payments, you have to be extra cautious, extra careful, have these foreign vendors complete W8BEN. The onus remains on you. If after 6 years, if tomorrow we find out that there should have been a withholding that you did not do, we will hold you responsible for it, and we'll try to penalize you to collect money for the withholding that should have come out of the foreign payment.
Okay. Now, question about domestic contractor. Earlier question was for foreign contractor, but for domestic contractor, AJ, what if someone pays that contractor, some money cash and some money online using one of the apps or something like that? Then what should they do preparing 1099 for that contractor?
So before you make any payment, get a W-9 form signed, so you know their full name, you know their social security number, you know their address. If it's an LLC, S Corp, proprietorship, partnership, you know their EIN number. You want to include the total payment. It doesn't matter how the payment was made. It doesn't matter if the payment was made via cash, Zelle, Venmo, check, That's not important here. Whatever the total payment you made in the whole year. Let's say if you have been making $100 payment to the cleaning lady every month, you need to issue a 1099 for $1,200. So one single 1099 for the total payment that you made throughout the year, irrespective of how you made this payment.
All right, and quickly, AJ, as we have less than 2 minutes left in the show, any major mistakes that should be avoided when they get 1099? Earlier, you mentioned about the name and SS number or the TIN number and everything else, but anything else that you like to add so that our viewers will know that what are the mistakes that should be avoided?
Absolutely. So we have been talking about the payer, we have been talking about the business side of it. But if you are the one who is receiving the 1099, make sure you check your own books to confirm that the amount that's reported on the 1099 is the right amount. Remember, you have to pay tax on this amount. So if this amount is higher than what you received, now you're expected to pay more taxes than what you should have. If the 1099 amount is not right, please immediately contact the business that is issuing this 1099 to you to get this 1099 corrected. Make sure you check the last name of the 1099. You want to make sure the information on this 1099 is right the way you want to see it. And if there are any question, please go back to the business that's issuing this 1099 to get it corrected ASAP.
Okay, last question quickly. With these apps where payments are easily made to the contractor and everything else, so the person who makes the payments and person who receives the payments via these apps, do they really need to keep very, very good record of it, what was paid and what was received to prepare 1099?
Absolutely. See, at the end of the day, if you want to claim this payment as an expense, you have the obligation to prove it. IRS has 6 years to come back to you to say, why did you claim this expense? We deny this expense. So the onus, it's your responsibility to track all these expenses. So if you are making significant payment to somebody, especially if you want to claim this payment as a tax deduction from your income, you have to maintain this payment. If you are receiving this payment, you want to track it also. If somebody is issuing you a more 1099 than what you actually received, because they can claim higher expenses. Somebody gave you only $1,000 and now they issue a $10,000 of 1099. So they can claim 10,000 of benefit. They can claim 10,000 as a tax deduction. But if you only got $1,000, you don't want to pay tax on $10,000. That's why tracking these payments is extremely useful when it comes to taxes.
Okay, this information has been extremely useful also for our viewers. AJ, thank you so very much. We touch base upon 1099, the importance of 1099 and everything. And should you miss anything, should you want to get more information, reach out to Sai CPA Services, 908-888-8900. Tell them that you saw the show on TV and then you have question. And for your tax returns, do contact Sai CPA Services and they'll make sure to have your taxes done right. Once again, their phone number 908-888-8900. Visit their website, saicpaservices.com. So we are thankful to Sai CPA Services for sponsoring the show. We are extremely thankful to Suhag Jewelers for sponsoring the second half of the show, the Tax Talk with AJ. AJ, once again, thank you so very much.
Absolutely. Thank
Until
you.
we meet again, same place, same time, I am Sanjeev Pandya, wishing you all tax-free and happy gold shopping days ahead. So long.
Thank you.
Hello, namaskar viewers. I'm Sanjeev Pandya welcoming you to this week's edition of the Tax Talk with AJ right here on ITV Gold. The show is sponsored by Sai CPA Services, a complete professional accounting firm, one of the best accounting firms in the state of New Jersey. Multiple locations can assist you with your personal tax returns as well as corporate tax returns or any tax related matters. But more than that, they can also help with your business's bookkeeping services, payroll services. They can also have virtual CEO and CFO for you so that way you can focus on your business. Sai CPA Services believes doing taxes right for their clients. For more information, you can give them a call at 908 908-888-8900. That's a 908-888-8900, or visit their website, SaiCPAServices.com. With that note, I'd like to welcome Mr. A.J. Kumar of Sai CPA Services with over 25 years of experience. And A.J. Kumar is a CPA, CBA, and MBA with Sai CPA Services. Ajay ji, welcome to the show.
Thank you, Sanjeevji, and thank you for the kind introduction.
Absolutely, sir. Introduction is important, and with introduction, right introduction is also extremely important, so that way clients know that why Sai CPA Services is so special for all their accounting needs. One, obviously, they do taxes right. They also advise you, guide you on your taxes matter, and they want to make sure that whatever deductions are coming your way, they'll make sure that you take those deductions. So, Sai CPA Services is known among their huge list of clients is the best accounting firm here in New Jersey. So, AJ, you're most welcome with that one. All right, now this week we're going to discuss about business structures. It's very important. You want to start a business, and then obviously you really need to know whether you should have a LLC, C corporation, S corporation. Depends upon a business. Whether is it manufacturing, is it research and development, is it just a retail services? All these things applies to the entity of the business that you're going to set it up, that you're going to decide to have it, because it also depends upon your personal taxes, personal income tax, personal income, and everything else, because sometimes it flows through your personal income tax as well. So having a right business entity is the number one and a correct step, so that way you can file your taxes correctly, you can pay your taxes correctly, and that's why Sai CPA Services will guide you for that matter. So, in case if you are just getting ready to start a business, either you or your spouse, then AJ is going to give you very valuable information in this episode. Sir, LLC, C Corporation, S Corporation, limited partnership, kya kiya jaye?
Absolutely, Sanjeevji, and very well said. So, not just if you are starting a business now, if you already have a business, this is the time of the year when you need to take a step back. Look at it, if the structure that you have is the right structure. Does it still make sense? A lot of time people start somewhere, then they outgrow the structure. Now they are more profitable than what they were. So maybe the structure that they have does not make sense. So choosing the right business structure for a new business, for an existing business, for a future business makes a lot of sense when it comes to tax planning. During this time of the year, now 15th October, the tax season is over, Diwali is over, you have 2 months to do the tax planning. So especially if you are a small business owner, please take a step back, look at what businesses you have. Is it LLC, S Corp, C Corp, why? When did you start? Does it still make sense? And have this conversation with your accountant. Give us a call if you need help, and we'll be happy to help you to decide if the business structure that you have, that you want to have, makes sense for your type of business.
Okay, absolutely, because as AJ said, folks, correctly, that choosing a right business is really, really important. So let's say among all these various entities, let's start with a very common one, LLC one.
Absolutely, Sanjeevji. LLC stands for Limited Liability Company. If you don't know anything, or people who are deciding themselves, more than likely they end up choosing LLC. Only because LLC comes with a lot of flexibility. LLC has the limited liability protection, so it has some security around it. And with an LLC, you can file the taxes on your personal tax. If it's a single owner LLC, you can file the tax as partnership, 1065 filer. If you have a partner with you, you can file the taxes for an LLC as an S corporation. It still flow through, but no self-employment taxes. Or you can file the LLC taxes as a C corporation, where you file the business taxes separately and do not have the flow-through type of nature from the business profit. So LLC is the most flexible structure that this country allows. LLC can file taxes in 4 different ways. So in total, Sanjeevji, there are 5 different type of business structure.
Yep.
LLC, we call it number 3 from the high to low perspective, allows you to file taxes from the remaining 4 perspective. LLC does not have its own tax form. You can file the LLC taxes in any other form, in any of the other 4 remaining formats.
Okay. And LLC, as I understand, is also very, very good for small to mid-sized businesses.
LLC is extremely good for small to mid-sized businesses, the businesses that are trying out, businesses that are not sure how much the profit is going to be, or businesses that are not expecting to have profit. And you wonder, why would I have a business if I'm not expecting to have profit? Say, for example, if you have a real estate business have depreciation, mortgage interest, property tax. So on paper, after you factor the depreciation, which is a non-cash expense, generally speaking, your taxable profit will be negative. You will not have any profit if you do it right, if you plan it properly. After deducting the mortgage interest, property tax, depreciation, on paper, for a real estate transaction, you will not have any profit shown on the books. In those cases, LLC is perfect.
Okay, very well, thank you. Out of 5 entities, AJ, 3 of them are very popular. One is LLC, the other one is S Corporation, and the C Corporation. All 3 of them have one thing in common, which gives you limited liability protection. Can you shed some light in a layman's language for our viewers? What exactly is liability protection?
Absolutely. So, as the term says, limited liability. So LLC stands for Limited Liability Company. What it means is liability for an LLC is limited to the asset that the LLC has. Say, for example, if you have 5 real estate properties, you create 5 different LLCs, one LLC for each property. If something is to go wrong with one LLC, only that property is exposed for the legal lawsuit, not the remaining 4 properties. So the liability is limited to the extent, the value of that LLC, the property, the asset that LLC has. That's why they call it limited liability company.
Okay, very well. Thank you so very much. The other thing is, limited liability corporation (LLC) is a pass through the taxation, through the personal tax return or the corporations. That is one of the things, right, for LLC?
It depends. As we discussed, LLC can file taxes in 4 different possible way. It can be included on your personal taxes. If it's a
Yes.
single member LLC, it can file a separate partnership type of return. We call it 1065. And LLC can choose to elect S election. So it could be filing as pass-through S corporation, and LLC can choose to file taxes as a C corporation, where the taxes are not flow-through, where the taxes do not get included with your personal taxes, and taxes are filed separately. So LLC provides the most flexibility when it comes to the tax filing type.
Perfect, very well. So now after LLC, now you just touch base upon S corporation. S corporation, is not the pass-through. It's kind of what they call is double taxation.
No, I'm sorry. S corporation is pass-through. What they call double taxation is C corporation.
Oh, okay, all right. So S corporation is the pass-through, correct? My bad. So let's just talk about S corporation and what are the benefits or rather advantages and disadvantages of the S corporation.
Absolutely, Sanjeev ji. So LLC has pass-through nature, limited protection. C corporation, on the other hand, is a much larger corporation, bigger liability protection, more compliance. S corporation provides an hybrid structure, best of both worlds. S corporation has the flow through nature, pass through nature of the LLC, and the liability protection or the corporate nature, compliance of the C corporation. So S corporation is an ideal structure if you have a profitable business, if you have a consulting company, professional service company. For most doctors, attorneys, accountants, architects, S corporation is the preferred structure. S corporation has several limitations around it. S corporation cannot have more than 100 owners. What it means is, and you say, hey, 100 is 100, it's a lot of number. But that being said, S corporation cannot be a publicly listed company. When you have a publicly listed company, you issue stocks and a lot of owners can be there. So publicly listed company cannot be an S corporation. S corporation cannot have foreign ownership. S corporation must have the resident, US resident, a green card holder or a citizenship as the owner. S corporation cannot have different type of stocks. S corporation cannot have preferred stock or regular stock. So S corporation comes up with lot of limitation. And you ask, well, if this S corporation has so many limitations and is as good as flow through nature that LLC has, why would anybody choose S corporation? Why not everybody choosing LLC? because LLC pays self-employment taxes, which S corporation does not pay. Take an example. If you make $100 of profit in an LLC, over and above your income tax, you have to pay $15, almost $15 in self-employment tax on that profit. In S corporation, the self-employment tax is not there. You have to run the payroll, a reasonable payroll, but in theory, S corporation will be ahead in terms of lower tax liability when it comes to comparing LLC and S corporation.
All right, very well, very useful information. So we're going to take a pause right now, and when we come back after the messages, AJ will give us more information on the other entities. Remember, your business structure is extremely important when you start a business, or even if you have started a business and if you think that it's not really helping out in a way that it should really help out with your taxes, you can always change it from one entity to another entity. And how you can do that, that's all coming up after these messages. Moving on to the show, folks, in case if you have just joined us, today's topic is the business entities, business structure. Out of 5 of them, which one is right for you, for your business? That's exactly what we are discussing. We touch base upon LLC and S corporation, right? So now we're going to go into the C corporation. How C corporation is different than S corporation? One thing is that if you're planning to go to a public company, then you need to have a C corporation. S corporation cannot go to stock market, correct?
Absolutely. C corporation is a preferred structure when it comes to financing. If you are an angel investor, you always prefer a C corporation. You don't want to be going through S corporation or LLC. You don't want that exposure to be reflected on your personal taxes. Remember, LLC and S corp, they're both flow through entity, pass through entity. The profit shows up in your personal tax return. So when you have a financing options, when you are looking for loans, when you are looking for angel investment, all those people prefer C corporation. C corporation can go public. C corporation can have foreign owner. When you are going public, you don't control who is buying your stocks. You don't control who is buying your share. These people who are buying your share could be from different countries. You are not seeing what legal status, what immigration status they have. So C corporation allows foreign ownership. C corporation is a good structure when you are thinking about larger picture. When you have a business, say if you have a business in India, which is already successful, and you are trying to create a branch here. You know the business is successful, you're trying to create a branch. In that case, C corporation is good.
All right. So now my question to you, AJ, is a C corporation, obviously you could have owners, they could be all over the world and doesn't have to be only US green card or citizenship holders and everything. So if someone starts a company now and let's say 3 to 5 years, company really builds up goodwill and they decide to go to public, will they have to change from S corporation to C corporation, the company's entity?
Absolutely. They cannot really go to public under S election. They will have to convert this company, and there is a process around it to convert C Corp to S Corp or vice versa. You have to do necessary filing, seek approval, and lose the S election, make it as a C corporation before going to public.
All right. And then when you say seek approval, I guess approval comes from SEC, Security Exchange Commission, correct?
Well, no. S election approval comes from the state and the IRS.
Okay.
SEC is the secondary filing. You cannot do the SEC filing under S election. First, you have to change it to a C election, C corporation, and then only you are allowed to do the SEC filing.
All right. So for any startup company, let's just say pick on technology, because our community is very well, invested into technology. If someone wants to start a startup company in technology, either they should go with LLC or the S corporation to begin with.
Typically, in a technology company, just because you are selling your time, there is nothing else to sell. So profits are high. Meaning generally the net profit is 40%, if not higher. In those cases, instead of LLC, where you have to pay self-employment tax on the net income, you should prefer S election, S corporation. So generally speaking, if you are a US citizen, green card holder, for your IT consulting company, you go with S corporation. If you have foreign ownership, you have an Indian company and the Indian company will own the US company, or you are thinking about L1 visa, or you are thinking about multiple owners where one owner doesn't have the social security number. In that case, you are forced to do C corporation. I'll remind our viewers, in order to start a company in this country, you don't have to have a social security number. We do a lot of business startup where people have never been in this country. They don't have a visa. They don't even have the Indian passport. Forget about the US passport. And they have the right to start a C corporation or an LLC in this country. LLC and C corporation both allow foreign ownership. We prefer C corporation because later on C corporation provides higher flexibility, and using C corporation you can have your own L1 H1 visa under your own company.
Okay, very well said. Good. All right. So now let's, keeping time situation in mind, let's go with the limited partnership and the other entity called sole proprietorship.
Absolutely, Sanjeev ji. So we said there are 5 different type of structure. So the way you want to look at it is proprietorship, which one person just doing the business himself or herself. There is no registration needed. You just go to county, say this is what you intend to do. I mean, you are still obligated to do sales tax filing and all the other filings depending on what you are selling, what you are doing. But proprietorship is the easiest structure to start with, almost no compliance needed. Next thing is partnership. As the name says, partnership has to has more than one partner. If you have 2 people coming together, let's work together. You do this, I do this, you bring in this much money, I bring in this much money. That's typically a partnership. Very, very simple, simplistic structure, little bit more filing than the proprietorship. Then comes LLC. LLC has a lot of flexibility where you can file taxes as a proprietorship, as a partnership, as an S corp, as a C corporation. LLC allows foreign ownership, a lot of flexibility, except in LLC on the profit you pay self-employment tax. So if you have a real estate company, as we said in the first segment, no profit expected, go with LLC. If you have a company that you're trying out, LLC. Remember, LLC can later be converted into other format. Then after LLC, S corporation and C corporation. So again, in the order of proprietorship, partnership, LLC, S corp and C corp. As we move from proprietorship to C corp, the complexity increases, the liability protection increases, cost of doing business increases, administration increases. So you have to see which phase you are in your business. Proprietorship is the easiest one, and C corporation is the most difficult one, most compliant one. Yep. You have to see what makes sense in your case.
All right, very interesting. So now let's say to explain to our viewers, all these major companies here in USA who are publicly traded companies, either in S&P 500 or NASDAQ or Dow Jones, they are all 6 months or a year before they go to public and everything. Can they do C corporation from the beginning and wait till they get the approval to have their IPO come out, or they have to do S and then change it to C?
I think in many cases it makes sense to do C corporation from the beginning. If you know that in 3 to 5 years you will be going public,
okay,
or if you have foreign ownership, or if you think you will need the investors investing money into your business, you will need venture capital, angel investor, they will all prefer C corporation. In that case, it will make sense for you to start the C corporation right from the inception, as opposed to convert one type of company into another.
Okay. And in case if that project fails in the sense, if they decide not to go to public, they can always change it to S corporation.
They can always change the C corporation into S election.
Okay. Very well. Well, with that note, we come to an end of it. And folks, as you know, the end of October is almost around the corner. Hope you had a wonderful Diwali celebration with your friends and families. Now it's really time for you to take a moment, sit down, look at your finances, look at your yearly income right now. Take a look at it, where you stand and where you're going to end up at the December 31st. That means how much income you're going to have, where are you planning to invest the money. Because remember, taxes are taxes. Everyone must pay their taxes, their share of it, whatever it is. But how you can save on your taxes. Just to save on a taxes, that means you can invest money in several plans. Obviously most popular one, kids education, and if you are a grandparents, you can give it to your grandkids and whatnot. So this is the time that you really need to look into it. And before December 31st, you must invest into any one of those plans to save your taxes for the next year when you go to file a tax return for this year. And for that, I strongly suggest you to take advice of Sai CPA services. They're knowledgeable on-hand CPAs, experienced CPAs, and Mr. AJ Kumar himself will personally advise you and guide you by looking at your finances, the where you should be and what kind of plan that you should be putting money in. So that way you can save your tax liability, because saving tax liability is the smartest thing to do. So please take action right now. Give them a call at 908-888-8900 or visit sciencecpaservices.com. AJ, if you'd like to have a final word on that.
Absolutely. No, you said it very well, Sanjeev. A dollar saved is a dollar earned.
Yep.
This is the time of the year. In next 2 months, if you do it right, you can definitely make a dent to your tax liability.
All right, and that's why we are continuing to reminding you, and we'll continue to do so. Thank you so very much for watching the show. AJ, thank you for your time.
Thank you,
and
sir.
until we meet again, same place, same time, I am Sanjeev Pandya, wishing you all a very happy tax-free days ahead. So long.
Thank you.
Namaskar viewers, I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ right here on ITV Gold. The show is brought to you by Sai CPA Services, a professional full-fledged accounting firm located in the state of New Jersey, multiple locations, but they can assist you with your personal or corporate taxes wherever you are in USA. They're easy to reach and they believe in doing taxes right. They're on-hand, knowledgeable, experienced CPAs at any time will guide you, navigate you by setting up an appointment with them by phone call or even a Zoom call. It's all possible. For more information, give them a call at 908-888-8900 or visit their website sciencecpaservices.com. With that note, I'd like to welcome Mr. AJ Kumar of Sai CPA Services, who is a CPA, CVA, and MBA with over 25 years of experience and knowledge and expertise that he has developed in the world of taxes and accounting and everything, that he joins us every week to guide us and inform us about taxes. AJ, welcome to the show. Good to have you.
Absolutely, Sanjeev. And thank you. Thank you for the kind introduction.
Sure, absolutely, because I know Sai CPA Services all these years, and I know that how professional they work, and that's why it is my duty to let viewers know that for any tax matter, you should consult Sai CPA Services. At least set up an appointment, have them review your taxes and see how they can help you, and you'll be very pleased. I can almost certainly guarantee you with that. All right, so moving on with the show, and today's topic is very interesting. Okay, we are in month of November. Nobody wants to think about taxes. But I always say in the episode is that this is the time, November and December, this is a time to accumulate all your tax information, as many details possible, especially if you are a high net worth taxpayer. That means obviously you want to save taxes, and tax codes and regulations allows you to save taxes. That means you can invest money somewhere else and reduce your tax liability. So that's a one thing, and I say that this you must do it before December 31st. So this is the time for you to review that. Second is that if you have a foreign bank account and foreign income, you really need to pay attention what AJ has to say in this episode. It's really important because what's happening in USA by the government of USA can also have an effect on your foreign bank accounting and the incomes and everything that you have. So let's hear from AJ a little more detail on FBAR and FATCA, known as FATCA.
Absolutely, Sanjeev. And you are very right. Right now, this is the time for planning. With the current immigration situation, with the current political situation, you need to take a step back, take a look at your current situation. Do you have properties in India? Do you need them? Do you have bank accounts in India? You want to simplify your situation. How much money do you need in India? What are the rules around FBAR, foreign bank account reporting, FBAR filing? What are the rules about foreign asset reporting filing? We call it FATCA filing. The last thing you want is to miss something unknowingly. The best part, you ask? There is no taxes when you file FBAR or FATCA. FBAR and FATCA, they are both information filing. It does not create any tax liability. What it means is You have absolutely no reason not to file FBAR and FATCA if you are expected to file. If you are supposed to file, please do yourself a favor, keep it clean. You do not want the system, especially if you are a green card holder, especially if you are here on a residency visa, you do not want to give the system an excuse to say you did not do something that you were supposed to do.
Absolutely. AJ, first question I want to ask you is that the purpose of this, even though you explained it, but the purpose that we know, but what if somebody still ignores it? What could happen? Let's start with this, hypothetical question that the purpose is to file it to let U.S. tax department know that you have these foreign bank accounts and income. But if someone continues to ignore it, what could happen?
Well, we have to look at the magnitude of the situation. We have to see how much money you have. Then we have to know if it's a willful neglect or you made a mistake out of it. And then we have to see if you are an accredited investor, if you are making more than $250,000 for at least 2 years, meaning it's a holistic situation that we'll have to see. If you take a step back, the worst case scenario is really, really bad. The way the rule was designed, when the September 11 happened, a long time ago, when the World Trade Center fell, they decided, they did a lot of research into it. How did it happen? Why did it happen? And what could have been done to prevent it? And one of the conclusion was it takes a lot of money, lot of transactions, lot of foreign money to do something like this. So if we can track who has foreign money, if we can track the transactions around it, the maximum amount, the minimum amount, then probably we could have found it out. So the worst case scenario has been made really worst. Not only it carries thousands of dollars of penalty, it has the jail time. The maximum penalty could be 400% of the amount you had at any time in the account. If you had $15,000 in your bank account outside this country, the penalty could be as much as $60,000. You do not want to be thinking about the worst case scenario. The advice here is there is not enough money to get into trouble. So you want to understand, you saying I did not know it is not going to work, doesn't work anymore. We have a new regime here. We have new political situation, new immigration situation. Make sure you take a step back, look at if you're supposed to be filing the FBAR, look at this episode, do some research. We'll give you the details, we'll give you the limits, we'll give you why you should file, when you should file, and how you should file. But the onus, the responsibility remains on you to make sure you file FBAR and FATCA.
Okay, very interesting. Now, now we know the importance of the filing of FBAR and FATCA. What are the foreign assets that should be reported in the U.S., which falls under FBAR or FATCA categories?
So FBAR is more related to liquid assets, Sanjeev. So it's called foreign bank account reporting. It includes the mutual funds, it includes the cash value of life insurance, it includes PFIC other than the regular checking, saving, fixed deposit type of bank account. Anything that can be converted into liquid asset, money, actual cash overnight is what's covered under FBAR. And again, FBAR covers the regular bank accounts, fixed deposit, checking, saving. It also covers the mutual funds, stocks. It also covers cash value of life insurance, which you can liquidate overnight. It also covers PFIC. On the other hand, FATCA for an asset is more about fixed asset. FATCA reporting is meant for, I used to have a house, or my parents passed away, they left a house for me, or I invested into a house where I was paying some X amount of money every year. Now it's on rental. I have a shop. Anything that's designed as a fixed asset. It could be your investment in a business over there. It could be the house that you used to live in over there before you came over there. Now it became an investment property for you because you have a house here, because you have a primary house here. So all the fixed assets are covered under FATCA filing. All the liquid assets are covered under FBAR filing.
FBAR, okay. Fixed asset and a liquid asset. Very good. Are there any thresholds which falls in these categories, FBAR and FATCA?
Absolutely. So if you are listening to us, please grab a pen, especially when we talk about the FATCA section. There are several limits around it, but FBAR is easier. Foreign bank account reporting is easier. If you had more than $10,000 at any given point of time during the year, in all your bank accounts added together, you have FBAR filing obligation. So let's take an example. If you had your Punjab National Bank had 2 lakh rupees, you had State Bank of India another 3 lakh rupees, then you had a local bank, you had another 2 lakh rupees. So in total you have 9 lakh rupees, which is over $10,000. Take another example. You have 5 lakh rupees in Punjab National Bank. You moved 3 lakh to State National Bank. Out the same 3 lakh, you closed the State National Bank, you moved it to another local bank, Bank of Baroda. You still have the filing up, it's the same 5 lakh, but if you add the maximum amount in all accounts added together, you have more than $10,000. You say, hey, it's the same 5 lakh rupees that are moving to three different banks. But again, we are not charging you any taxes. The idea is not to say that this is the tax you owe. The idea is to track the transaction. We are trying to see how the transactions are moving. Go back to the intent of the rule. So if you had more than $10,000 in all bank accounts combined together, you have an FBAR filing obligation. In that case, you're supposed to file, you're supposed to report the maximum amount in all the bank accounts that you had, along with the bank account number, bank name, bank address, and the maximum amount. So again, going back to the same example, if you have 5 lakh rupees that you're moving around, you will be reporting 5 lakh in a Punjab National Bank, 5 lakh in Bank of India, 5 lakh in Bank of Baroda. Even though it's the same amount, but we report the maximum amount in that bank at any point of time.
Okay, interesting. Let's say if somebody has 10,000 or equivalent to 10,000 currency in India in one or several bank accounts, doesn't matter. When they report it here, the number one question that any taxpayer would have in mind, would I have to pay taxes? How much taxes would I have to pay? I have maybe 10,000 now. Next year, I may have 25,000. So let's talk about tax implications on the total amount that they have in their India's bank accounts.
And that's the best part. There is absolutely no tax on this amount, zero tax on this amount. You can have $10,000, you can have $10 million. We just want to know how you got this money, where you got this money. Let's say hypothetically, if you sell a property in India, then capital gain is taxable. You probably filed the taxes in India, you will report that amount in US, but just because you have X amount of money in India, X amount of money outside this country, does not create a tax liability. You can have 10,000, you can have 20,000, you can have 50,000, and it could be coming out of your provident fund, it could be a gift from somebody, does not create a tax liability over here. The tax liability is created by the transaction. If you say, I have a business over there and I'm earning money, then you should be filing the Indian taxes, and the taxes that you paid to the Indian government becomes a tax offset to the US government. There is no double taxation here, and there is no taxation on reporting in FBAR or FATCA.
Interesting. All right, so that's good to know. Last question before we go into the break. All right, pension money, provident fund money, obviously they pay taxes in India, so there's no double taxation here. What if somebody sells a property over there? I assume someone sells a property and they pay whatever the taxes, capital gains and local, state, city taxes, whatever, they pay that. And if they want to bring that money here, let's say if it's $100,000, what do you suggest to them?
Well, you have the legal right to bring this money. We just have to report it.
Correct.
So you sell the property in India, and your capital gain is $100,000 in this example. So this $100,000, you paid some taxes in India. In India, remember, we use indexing. So you have to see how much capital gain taxes are paid. Let's say if you paid $10,000, you bring this money over here. We say, well, what is this money? Oh, this is capital gain tax. I already paid tax in India. Oh, from our perspective, you fell in 15%, not 10%. So you pay us 5% more in this example. So there is no double taxation, but in this example, in many situations, you may end up paying a small amount to the US government as well as an Indian government if there is a tax difference, if the US tax bracket is higher than the amount of taxes that you paid in India, and you say, how do I know the tax bracket? You have to look at a whole situation, how much money you are making. The system, US system, has multiple tax bracket depending on the income that you have.
Okay.
So if your US tax bracket is higher than the Indian tax bracket, in that case, you may have a small tax. The difference may need to be paid as well.
All right, very good information. The bottom line is it must be reported. So that's what the summary of the first half of the show is. In second half, we're going to go a little more deeper. So stay with us. We'll be right back after this messages for the Tax Talk with AJ. Thank you. Let's continue the second half of the show. Today's topic is FBAR and FATCA. This both have to do with your foreign bank information, foreign bank accounts, assets in the foreign countries such as India or anywhere else in the world. That must be reported here on your US tax return just for reporting purposes. But there are some details that you really need to know. In the first half, AJ gave us a lot of information, and the bottom line was that you must report it. Don't worry about the taxes in the US because the taxes may not apply to you. You may not have to pay taxes. But if you don't report it, and if they find out, then there's going to be a huge penalty. All right. So let me start with this question, AJ. My question to you is, let's say if somebody didn't report it and somebody wants to report it or somebody wants to amend the tax return, how many years can they go back if it's possible to go back?
So there is no such limit in how many years they can go back. The question typically asked is how many years they should go back. And we look at the situation, the magnitude of the situation. If we are doing just the FBAR filing, we can go back 3 years generally to do the FBAR filing. If there is interest income that was earned and was not reported, that changes the situation. We'll have to look at the magnitude of the whole situation. If the interest earned is a small amount, we can just amend 1 year and include the last several years' interest together. If the interest earned is significant as unreported income, meaning they earned interest in India, they did not report the foreign bank accounts, they had some TDS deducted. In those cases, we have to take a look. But generally speaking, we recommend going back 3 years to amend the returns for FBAR filing. Please understand, you cannot do FATCA filing separately. FATCA filing requires an amendment. It's mandatory. You cannot do 8938 filing without amending the taxes. FBAR, on the other hand, can be filed separately without actually going through the full amendment.
Okay, very interesting. Now let's just talk about, I know in the FBAR you mentioned to us that 10,000 is the limit. On a FATCA, can we go a little bit more detail as the threshold is anywhere, if I understand correctly, $50,000 to $600,000, but it all depends upon your status. How are you filing a tax return?
Absolutely, very well said. So even though it seems that the limits are 50,000 to 600,000, which is absurd high, but if you take a step back, if you are a US citizen, if you live in US and you are a single person, then the limit is 50,000, meaning if you have foreign assets over 50,000 during any time of at the year end, then you must file FBAR. If this 50,000 limit changes to 75,000 if the same asset had more than 75,000 during the year, meaning the rate keeps fluctuating. You had a property, you sold the property. So the year-end limit is 50,000. During the year, at any time, 75,000. If you are married, this 50,000 changes to 100,000, and during the year changes to 150. Meaning, if you are married filing joint, if you had more than $100,000 of asset at the end of the prior year, you have FATCA obligation. During the prior year, if the assets were worth more than 150, then you have the FATCA filing obligation. If you are living outside US, the limits are 4 times higher, meaning the 50,000 goes to 200,000. If you are a single person and if you have assets worth 200,000 at the end of the year, then you have the FATCA filing obligation. The promise here is you are a US citizen, US green card holder, US resident, living outside US and filing the US tax return. In married filing joint cases, the limit is $400,000 at the end of the year or $600,000 at the end of the during the year. So the $50,000 single filer living in US goes to 600,000 when we talk about married filing joint or the couple living outside the country. So you have to be careful in what limits you fall in, and if you have the FATCA obligation. If you do have the FATCA obligation, the form that you're supposed to file is 8938, and this form cannot be filed separately. The form must go together with your personal tax return. The deadline for 8938, meaning FATCA filing, and the deadline for FBAR filing are the same deadline that you have for your personal tax filing. If you extend your personal tax filing by filing an extension, in that case, your FBAR and FATCA filing obligations automatically get extended to the personal tax filing deadline. So if the deadline is generally April 15th, if you file an extension, then it's extended to October 15th, 6 months.
Okay.
In that case, FBAR and FATCA is also going to be due by October 15th.
Very well. Now, okay, having said that, now got all the details about FBAR, FATCA, and why it needs to be filed and limits and everything. My question to you is that we are in USA, the taxpayer is in USA. How do you value foreign assets?
It has to be a general value. The question generally that we are asked, I bought it for $100,000. I don't know what the value is. We don't care how much you bought it for. What we care is what's the current market value of this property. In the worst case scenario, you can ask a realtor, you can ask a broker, I want to sell this property, how much can I get? But at the end of the day, it's your value. As long as it's in the right range, we are okay with it. And remember, the promise here is we are not charging you any taxes. It's not a taxable transaction. It's an information filing. The last thing you want that you report $50,000 of asset, and after 6 months, you end up selling it for $5 million, then we'll give you a hard time. 6 months ago, you told me it's $50,000 worth, and you did not do the FATCA filing. Now you are saying that you sold this asset, which is $5 million. How did it change in value 10 times over 6 months? So you want to keep it honest as best as possible. Again, there is no taxes associated with it, so keep it in the right range.
Okay, excellent. Now, the question I have after hearing that, do you need to submit the foreign bank account statements or any transactions of capital gain and whatever it is as a proof? Let's say somebody has $100,000, right? Whatever, however, combined together. Does IRS require to submit bank statements of foreign bank accounts?
No. See, the US tax system is an owner-based system. When you say, I donated $10,000, we are not asking for the receipt at the time of tax filing. We are expecting that you have a contemporaneous receipt, you have a receipt in hand while you're claiming this expense. Same thing if you are claiming some deductions for the foreign taxes paid or foreign capital gain or local capital gain. We are not asking for any proof at the time of filing the taxes. Not that we cannot ask for it if somebody gets audited. They have to have those proofs for the capital gain, foreign transaction, taxes that they paid to the foreign government, the taxes that they filed with the foreign government. We will see all those details at that time. But at the time of filing the taxes, those details are not needed. They do not need to be submitted with the tax filing.
Okay, so then the question is, how does it impact FBAR or FATCA? How does that impact for a taxpayer here in the USA and even for IRS?
So for the taxpayer, if they keep it clean, if they keep it honest, then, and if they keep reporting their foreign assets, then tomorrow when they sell these assets, they have a legal claim. Remember, I told you I have a house in India, and I have been telling you the same thing for the last 7 years. That's the house I sold.
I see.
So it's easier for them to justify where they're getting the money and why are they getting a lot of money from a foreign country.
Okay.
From the government perspective, this is an idea about tracking where the money is going, where the money is coming from. And the US system wants to track, again, going back to our earlier example, when any big terrorist activity or any big fraud happens, it has a lot of foreign transactions involved in it. So the idea, the intent right from the inception was not to collect taxes, but to track such transactions.
Very well. Having heard from you, obviously, the importance of FBAR and FATCA, and the summary of this episode is that you must report it, because do not worry about the tax implications here in USA. You don't have to pay taxes. But For your future transactions, when you want to transfer the money from that foreign country to US, at least let's make it easier. And if it's a large sum of amount, might as well make it easier for everybody. So that way you're not, one is that there's no penalty for you and there's no question from IRS. So it makes it very, very certain. And all you need to do, just let them know that how much money you have in the foreign bank accounts and what's its worth and what's the value and everything else. So that is that. Now, viewers, this gets quite complicated and difficult to understand in a one episode because you really need to know, and everybody's situation is very different. What AJ is telling us is in a simple man's language that this is what you need to do. But should you really want to get some details, I suggest contact Sai CPA services. Give them a call, set up an appointment. In-person appointment would be much better if you are in local area. If not, obviously Zoom call would work also. Set up an appointment and let them review the whole situation, and they will advise you and guide you as they have been doing it for hundreds of thousands of clients for over 25 years. So Sai CPA services for all your accounting and tax needs. And by the way, they also can get you virtual CEO and CFO and also payroll manager in case if you want to focus on your small business, mid-sized business. So they can do that too. So do contact Sai CPA services, 908-888-8900, SaiCPAservices.com. AJ, many thanks for your for your input and sharing all the valuable information with us. I am Sanjeev Pandya, wishing you all happy and the tax-free days ahead. Until we meet again, same place, same time, and next week when we bring another episode of the Tax Talk with AJ right here on ITV Gold. You do take care of yourself. So long.
Thank you.
Hello, namaskar viewers. I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ right here on ITV Gold. The show is sponsored by Sai CPA Services, a full-fledged professional accounting firm located in the state of New Jersey with multiple locations. I always say these things because it really needs to be said because they are very professional. They are located in the state of New Jersey, multiple locations, but they can assist you with any tax matter across the state. So wherever you are, you can contact Sai CPA Services. 908-888-8900 is their phone number, 908-888-8900. Visit their website, SaiCPAservices.com. For any tax matter, personal or corporate tax matter, or even if you need a virtual CEO, CFO, or even a bookkeeper for your small to mid-sized business, Sai CPA Services can really help you out. And over the years, they have developed a very, very happy and a long list of clientele who come to Sai CPA Services for all their taxes and accounting needs. And just in case if you are in middle of IRS tax audit or if you have any letter from IRS regarding a tax audit, do not ignore that. Do not neglect it. Immediately contact Sai CPA Services because the record in also settling IRS tax audit is also very, very remarkable. So Sai CPA Services for all your taxes and accounting needs. And we are thankful to Sai CPA Services for sponsoring this show, The Tax Talk with AJ. With that note, I'd like to welcome Mr. AJ Kumar, over 25 years of experience, CPA, CBA, and MBA with Sai CPA Services. He joins us every week to guide us and to inform us about the tax reforms, tax laws, and tax and business matters. AJ, welcome to the show. Good to have you.
Thank you, Sanjeevji, and thank you for the kind introduction.
Absolutely. You're most welcome. And viewers, this is going to be the second part of the two-part series. Last week, we started to talk about this capital gains, how to avoid capital gains tax. It's not that you don't pay capital gains tax. I just really want to emphasize that you pay capital gains tax, but there are ways to avoid them for certain time, or there are ways that you can take advantage of the tax rules. And that's the point, that how to avoid them, not how not to pay them. And AJ has been giving us all the information we really need to know. Last week, we covered 4 topics. And now, this week, in today's episode, we're going to cover remaining 4 topics. And at the end of this show, we will discuss all the 8 topics in a summary altogether for your reference. All right, AJ, with that note, shall we start?
Absolutely, Sanjeev. And very well said. This is the year end. Everybody is thinking about planning, strategizing to minimize their tax liability.
Yep.
So if you have capital gain, please do check out the first episode. It's on YouTube, it's on ITV Gold, it's on Facebook. And the second episode will add a lot of value. So no two situations are similar, Sanjeevji. Everybody has a different situation. So not every strategy is going to be applicable to everybody.
Yes, this is not one size fits all.
Exactly. So there are 20 strategies, 25 strategies. We have identified top 8 strategies that we believe will be applicable to most people. So we discussed 4 in the last episode. We'll discuss 4 now. And then, depending on how much time we have, we'll try to summarize everything towards the end of the show. But please check out. We have YouTube, we have ITV Gold, we have
Yes.
Facebook. So the first episode is available on the internet as well.
All right, very well, AJ. With that note, let's begin the second part of this How to Avoid Capital Gain Tax series. And we're going to start with something very, very important, which I said in the last week's closing comments that we're going to discuss on 1031 exchange. This is a very familiar, very popular category among South Asians because South Asians they invest heavily into real estate, and this 1031 exchange has to do with the real estate and a capital gains part of the real estate. So here is to AJ to start with the basic information on 1031.
Absolutely, Sanjeevji. As you said, if there's one strategy that you want to know, one strategy that made most millionaires, that's 1031 exchange.
Very true.
1031 exchange only applies to real estate investments. So at a high level, the concept is when you sell the real estate and use that money, use the proceed to buy another real estate of similar type, you tell the government, I'm not selling anything, Uncle Sam, I'm only exchanging it, and hence the name 1031 exchange. 1031 is the IRC code. Exchange means I'm not selling. So you cannot charge me capital gain taxes because I'm not selling anything. You sell one property only to use the money from the sale to buy another property. That's exchange means.
Okay, so that's a 1031 exchange. Now let's go a little bit more deeper as far as the exchange period and the other rules apply to this 1031.
Absolutely, you have to be extremely careful when it comes to the rule application for 1031 exchange. There are a lot of companies who does 1031 exchange only. A lot of attorneys, your real estate attorney can help you with 1031 exchange. Very, very simple process. The idea is while you're selling it, within 45 days of the sale, 45 days, it's a very, very concrete number, you have to identify at least one, if not 3 properties that you are potentially looking at. You don't have to have a contract yet. You have to identify, meaning this is the property I'm selling. After selling this property, I'll buy either this or this or this. This whole process has to be closed. The second property that you're trying to buy must be closed within 180 days from the sale of the first property. So the difference in time between selling the first property and buying the second property cannot be more than 180 days. The proceed from the first sale must all be utilized to buy the second property. You cannot say, I need half the money, I need to buy a car, I need to buy a home, and rest of the money I'll use for 1031 exchange. All of the proceed from the first sale must be used to buy the next property. The property must be similar in nature, meaning if you are selling an investment property, you must invest into another investment property. You cannot be buying the primary home. You cannot say, I'm selling this house, which was a rental property and investment property. I'm going to use the proceed to buy a primary home. That will not be 1031 exchange. You cannot say, I'm selling this property, which was an investment property, and now I will invest this money into the stock market. I'm buying REITs, real estate investment trust, which is a type of stock, which is type of ETF. That wouldn't be okay either. So the property that you're selling, the risk level has to remain same from the property that you are buying. You can sell a shop to buy a residential investment property. You can sell a residential investment property to buy a warehouse, because for you, they are both investment properties, and that will be okay.
All right. So what you just explained, is that the one referred as boot in 1031 exchange category?
No, boot concept is slightly different.
Okay.
Boot meaning the additional money that you're putting in.
Ah.
Let's say if you are selling the first property for $1 million and you had purchased this property for $500,000. Now you're sitting on a capital gain of $500,000. Now you want to avoid this capital gain taxes. So what you do at the time of selling this property, you identify a couple of new properties, but there is nothing available for exactly 1 million. You have to say you are buying something for 1.2 million. Remember, the next property that you are buying, that has to be at least same or more than the property you are selling. All the proceeds from the first sale must be used to buy the next property. So the difference between the property that you're buying, in this example 1.2 million, versus the property that you're selling is referred as boot, meaning you have to put $200,000. If you go back to the gambling concept, they used to call it boot to start the play.
To start the game, yes,
To
exactly.
start the game. So that's how the concept comes up.
Okay. Now, that's good. The boot is very, very common and a very usual, reference that they use in 1031 exchange. Based upon your experience, AJ, that you have all these years of experience, what are the common mistakes that taxpayer makes about this 1031 exchange? What is it they really don't know that they should know, when they file the tax return?
Well, first and foremost, please do not try to do it yourself. You want to have professional help around it. There are a lot of rules around it. You don't want to mess it up. Second, you don't want to be touching the money yourself. From the sale of the property, the biggest mistake, if you have to identify in 1031 exchange, after selling the property, money cannot come into your personal account. Money must remain into attorney's escrow account. If you got the money, if you had access to the money immediately, that breaks the 1031 exchange right there. So the money has to remain into attorney's escrow account. Make sure you have the deal closed in 180 days. We come across a lot of situations, can my 1031 exchange can be extended? Is there a rule for extension? There is nothing like that. So you want to start identifying the next property even before selling the first property. Because you can identify, you can negotiate, you can do all the legwork beforehand. You don't have to be waiting for the first property to be sold before you buy it. If 1031 is in your mind, you know how much the first property is going to be sold for. At the same time, start looking for the next property.
Okay, so this is a very common mistake that a taxpayer makes without knowing it. Okay, all right, and you said the right thing, that do not try to do this by yourself. Even
Absolutely.
though if you think a tax software will help you, so and so forth, it's not the case. That's why you need professional and experienced CPAs, and AJ Kumar himself and his staff, which is filled with very experienced and knowledgeable CPAs on hand. They can really help you with this category or any capital gain or any tax matter. So you need to reach out to Sai CPA services. Anything else we need to add on the 1031 exchange?
No, absolutely. So make sure when you're thinking about 1031 exchange, it only applies to real estate. If you have a insurance policy, if you have stocks, even if you are selling the stock and using that money to buy the new stock, 1031 exchange does not apply. Even if your stocks are REITs, meaning based on real estate investment, even if you are giving a loan or investing money into a friend's property, that doesn't help. Meaning there are a lot of strict rules around 1031 exchange that applies to real estate only.
Okay, interesting. All right, so with that 1031 exchange, hope you've got enough information, valuable information that you really need to know on 1031 exchange. Now let's move on to the next topic, which is charitable giving, meaning, you're donating assets. How does that work and what are the rules for that?
So charitable giving is on everybody's mind. And if you do it right, charitable giving can do a lot of good things for the society and for your taxes. So let's start with gifting appreciated stocks first. Gifting appreciated market. So if you are sitting on an asset which has appreciated in value, and if you sell this asset first and then donate the money, you have to pay the capital gain taxes. and your donation is not really saving you that much money. Take an example. If you have appreciated stock, you bought something for $100. Now it's $1,000. If you sell this thing, you pay tax on $900. As opposed to selling the stock, if you donate this appreciated means increased in value, $1,000 worth of stock, your donation is counted at the market value. You get the benefit of $1,000 of donation and you do not have to pay any capital gain taxes. So when your assets increase in value, appreciated asset, you do not want to sell them. If donation is in your mind, donate appreciated stocks, appreciated asset. If your assets or stocks have depreciated, gone down in value, you want to sell them first so you can get the benefit of the loss that you had and then donate the money. So just remember, appreciated meaning increased in value, donate the asset, donate the stocks. If it gone down in value, depreciated asset, depreciated stocks, sell them first and then donate the money.
Okay. All right. Very well. Simply that you explained it. With that note, we're going to take a short break. We covered two topics right now, and after the break, we're going to cover two more topics. We'll be right back after this messages. With that note, let's move on now. Our topic, how to avoid capital gain tax. And listen, viewers, take a look. It's avoid, not that not to pay. So just avoid it using the tax rules and regulation that allows you to avoid to pay heavy taxes when it's not necessary to pay heavy tax. You can pay minimum tax and then avoid paying heavy taxes. So now we're going to go to the category number 7, and this is for the qualified small business stocks.
Absolutely, Sanjeevji. So QSBS is going to be the next 1031 exchange. If there is anything when it comes to capital gain taxes that people are talking about, that's QSBS. If you have not heard QSBS, please work with your accountant, work with your attorney, work with somebody. Go on internet, read about QSBS. A lot of businesses are converting their business into C corporation so they can avail the benefit of QSBS. If you are at a point where you are thinking about exit strategy for your business, where you'll be retiring in the next 3 to 5 years, look at it again, QSBS. If you have a situation where you know that this business that you started yourself and have created a lot of value in this business, you can sell this business for millions of dollars. How do you avoid paying the capital gain taxes? How do you not pay the capital gain taxes when you sell this business? Again, QSBS. So let's talk about how the concept works. Then we'll talk about what are the limitations around it, what are the rules around it, and then you please read about it. So as much information as we want to cover in this 30-minute show, it's a teaser trailer. The onus, the responsibility remains on you to learn more about it, to make the right calls, to find it on the internet, to find with the accountant, attorney. This show is only to help you understand what's available out there, so you can ask the right question. QSBS, they call it Qualified Small Business Stock. So the idea here is, if you invest money into a qualified business, and the qualified business is very, very similar to SSTB type of business. It cannot be doctor's office, it cannot be attorney's office, it cannot be accountant office. It has to be, and not SSTB, it has to be a qualified business. So there is a definition around it, what qualified means here. So if you invest money into a qualified business, and this business has to be a C corporation, not a flow-through entity, and you keep this money over there for 5 years, and you take this money out, meaning sell the shares of this company, you don't have to pay any capital gain taxes. And this limit used to be $10 million, meaning if you invested $1 million and now you're selling it for $11 million, you don't have to pay any taxes up to $10 million of capital gain. Now that limit has been increased to $15 million.
Okay.
So the rule now, the way it reads, the $15 million of capital gain taxes can be avoided, or 10 times of your basis, whichever is higher, can be avoided by investing money into a C corporation in a small business. And the small business QSBS, qualified small business stock, right? So small is defined as 75 million, under 75 million. It used to be 50 million. With one big beautiful bill, the 50 million was changed to 75 million. 10 million was changed to 15 million. So now the way this QSBS section defines small business, that it has to be under 75 million. The issue, the stocks have to be original stocks. You cannot repurchase the stock. There's somebody else owned the stocks and you are buying the stocks from that company. And why would they do that? They want to promote new business, new investment. The whole idea is to have people who are making money to invest into new concepts, new companies, where they don't have direct flow through nature, where they don't own the business. And again, this is not meant for a doctor's office, this is not meant for accountants, attorneys. This is meant for businesses like manufacturing business. You are selling, you are making something, R&D business. It could be staff augmentation. If you're a one-man IT consulting company where you are doing the consulting, I see that as SSTB. That wouldn't be qualifying. But if you have any staff augmentation where you have a lot of people who you hire and then you place here and there, then you're more of a broker. I see this still qualifies. So you have to be careful what a qualified business mean. You have to be careful. Similar to 1031 exchange, it's beautiful. It can save a lot of money, but you have to be careful with all the rules around it. Similar concept here. SSTB can save you capital gain tax on 50 million. Even if you are in 20% tax bracket, that's $3 million of saving. Best part, there is no net investment tax over here. There is no AMT, meaning the capital gain that you are saving here, that's free of NIT and AMT over and above the capital gain taxes. NIT could be 3.8% by itself. So not just you are not paying any capital gain taxes, you are not paying any net investment taxes, you are avoiding alternate minimum taxes. So as long as you follow the rules, you keep the money for 5 years. If you keep the money, and you ask me, I don't want to keep the money for 5 years, AJ. What happens if I take the money after 3 years? That's the best part. Earlier is defined as prior to one big beautiful bill, the condition was that you must keep the money for 5 years. Now, they made it more flexible. If you keep the money for 3 years, the 50% of the capital gain is waived. If you keep the money for 4 years, 75% is waived. If you keep the money for 5 years, 100% of the capital gain is waived. So it's a beautiful thing if you are in a situation where you're thinking about selling your business, if you're thinking about exit strategy, if you are thinking about retirement, if you are in late 50s, 60s, and you own a business, QSBS is the key. You must read about QSBS.
Very nice. It's a very beautiful concept, and in the bill, one big beautiful bill, they have made it even more beautiful.
Absolutely.
With this,
if it's possible.
Exactly. So now I have a couple of questions.
Please.
I had a question about 5 years, and then you answer the question. 5 years can be 3 years. Nice. $75 million. Now, how do they come up with the number? Is it the valuation of the company, or company, if it's just starting up, then a valuation should not be more than $75 million? Or who does the valuation? CPA like you for that company?
We can do the valuation. It's a separate license,
Okay.
a separate accreditation.
Which you have it, your
which we
CPA.
do. So it can be done outside, and a lot of time at the time of investment, it's a C corporation. The market defines the value. Whatever people are willing to invest, that's the market value.
Okay, fine. So that's a 75 million. Now, how does government qualify those businesses which fall into the category called qualified small business?
Absolutely. Beautiful question. So it's a two-part question. How do you define qualified? That qualified means there are certain type of businesses that government wants to promote. And this is how they include it. It's a separate definition. The definition is not exactly as of SSTB. It's very, very similar to SSTB. So you have to be careful. You have to work with your accountant to make sure you understand you're investing into qualified business. Pharmacy could be a qualified business. Doctor's office is not a qualified business. If you are giving shots at the pharmacy, at least 80% of the business has to be qualified in order for the business to be considered as qualified business.
How about restaurant business?
Restaurant is 100% qualified.
Okay.
So you have to be asking the right question. Once the business is qualified, you invest money, you must keep it in a C corporation. Most of the restaurants are LLC.
LLCs.
So you have to be, you can convert your LLC to C Corp, or you can sell the LLC, the equity into a C Corp, form a
Okay.
new corporation, issue the stocks, and buy the assets of the LLC or the S Corp that you have as a restaurant.
Very good. Viewers, you can get more information by dialing Sai CPA Services 908-888-8900 or visit their website saicpaservices.com. The reason I'm rushing, because for AJ, it's easy to talk. He can give you all the details that you really need to know. But time is of essence, and I'm told we have less than 2 minutes left.
Wow.
AJ, quickly, in a 1 minute, charitable trust remainder, CRT. That's the one we need to talk about quickly.
So remainder charitable trust, the concept here is, if you are old and if you don't have anybody to give your asset, or you want to give money to a charity, so instead of donating money now, where you wouldn't know how long you will be living and you want to have access to the money, so you create a trust where you are giving it to charity, the leftover amount. You decide how much money you are giving to the trust. It's a charitable trust. And then you say, I'm giving $1 million to this charitable trust, and this charity will give me $6,000, $5,000 a month till I leave. The day I pass away, this trust automatically gets dissolved, and this trust is going to be, this money is going to be given to these charities with this percentage, whatever the growth is or whatever the leftover amount. That's where the concept comes. Remainder means leftover money in this trust will be given to these charities, or this charity is whatever percentage you decide.
Okay, very good. With that note, we come to an end of this episode. This is the second part of the two-part series. So quickly, let me just summarize. In the last week's episode, we covered primary resident exclusion, then we covered tax loss, harvesting tax credit, then we covered qualified opportunity zone funds known as QOF, and then we covered donate appreciated assets. This all was covered in the last week's episode. This week we covered 1031 exchange, one of the hottest topics. Then we touched base upon charitable remainder trust, and then step-up basis debt, and of course qualified small business stocks. So all these topics covered for you to know about how to avoid capital gains tax. For more information, reach out to Sai CPA Services 908-888-8900 or saicpaservices.com is the website. AJ, as always, thank you so
Absolutely.
very much for sharing the knowledge with us and informing us. I am Sanjeev Pandya, wishing you all happy holidays, happy tax-free days ahead. Enjoy it as much as you can. It's end of November. Remember that in the next episode, I'll remind you about December, what you really need to do. All right? Do take care of yourself. So long.
Thank you.
Namaskar, viewers. I am Sanjeev Pandya, welcoming you to this week's episode of the Tax Talk with AJ, right here on ITV Gold. This weekly show brings you all the latest and the greatest and all the updates that you really need to know when it comes to taxes, corporate taxes, personal taxes, and any and all taxes related matter. Before I go any further, I just want to let you know the show is sponsored by Sai CPA Services, a full-fledged, complete professional accounting firm located in state of New Jersey, multiple locations. But wherever you are in the USA, you can contact them at 908-888-8900 or visit their website, saicpaservices.com, to have your taxes done right. That's what Sai CPA Services believes, to have clients' taxes done right, and that's why they have a very large number of satisfied clients who continuously get their tax advice and tax returns filed. So Sai CPA Services should be your point of contact for all your taxes matter. If you're in a business and if you're just a single owner of the business and you need virtual CEO, CFO, or payroll services or any other business related matters, virtually, Sai CPA services can help you in that area also, so that way you can focus on a business. So for all that thing, Sai CPA services. With that note, I'd like to welcome Mr. AJ Kumar of Sai CPA services with over 25 years of experience, CPA, CVA, and MBA. He comes every week, he joins us every week to share his knowledge with us right here in the Tax Talk with AJ. AJ, good to have you. Welcome to the show.
Thank you, Sanjeevji, and thank you for the kind introduction.
You're very welcome because, and one thing I want to add in my introduction is that Sai CPA services, of course, they have very knowledgeable and experienced CPAs on hand. The other thing they do very, very well, and I know through, the people who have experienced that, is that if you or anyone in IRS tax audit situation, Sai CPA services, really looks into very, very, very professionally into that IRS tax audit matter, and they will do best to resolve the IRS tax audit for you. They have done it very successfully for their corporate as well as personal clients, but they need to review all the details, and they can advise you and guide you. And I know, AJ, I really want to give you a compliment for that, doing it, because you have made many of your clients very, very satisfied in resolving IRS tax audit.
Oh, thank you. I appreciate that.
Sure. And IRS tax audit is something that, whoever gets it, obviously they panic, they worry, and they get nervous, but don't get nervous. Immediately contact Sai CPA services and have them review it. With that note, in today's show, we're going to talk about IRS tax audit. What triggers IRS tax audit? What should you do? What should you not do? All the details, we're going to hear it from Mr. AJ Kumar. So, AJ, the first question is, of course, IRS tax audit is always a burning issue, and a few people, when IRS randomly picks them up and they're audited, what triggers IRS audit?
Yeah, absolutely, Sanjeevji. And a timely discussion. We just finished the tax season a couple of weeks ago. A lot of people probably will be getting some IRS notices, some deficiency notices, some tax liability notices. So one thing we tell all our clients, all our viewers, that please, if you have a notice, if you have a letter from IRS, the last thing you want is to ignore it. Please do not ignore it. Whoever filed your taxes, if you file your taxes yourself, read through the notice carefully, call the number given on the notice, find the number on Google, on internet. A lot of time these notices are scam notices, and they have a phone number over there, and that number is also a scammer's number. So be careful which number you are calling and what website they're asking you to go, if they're asking you to pay immediately. So don't fall for any scam. If somebody is asking you to pay cash or these prepaid cards, that sort of a sign of a scam. IRS calls do not push you, do not force you to pay right away. They do not ask for a prepaid card. They do not ask for cash. And then you can always verify with an accountant, with a CPA, or by going to local IRS office if the notice that you have is a legitimate notice or not. And this is the season. You see, it's a Thanksgiving, Christmas season. It's a festival season. It's the season of a scam too. So we want to bring to your attention what are the typical IRS agents, what are the typical triggers for these IRS audits. So we can start with not filing the taxes properly. And what we mean here is if you don't report all sorts of income, let's say if you have multiple W-2s, some 1099, some rental income, some interest income, and dividend income from the stocks, some crypto transaction, and you are not reporting everything. So a lot of this information get reported to IRS before it's reported to you. So all 1099 copies, all W-2 copies are sent out to IRS before it's sent out to you. So IRS already has a record of what you should be reporting. When you file your taxes, if it's not syncing up, if it's not matching with the information that IRS has, more than likely you will get a notice. asking you to clarify why you did not include certain transaction.
Very good. Okay, absolutely. Now, one thing you mentioned about scams, yes, and scams going out, but another thing, viewers, that you should keep in mind is that IRS never ever calls a taxpayer. So if someone calls you and says that they are calling from IRS, it's definitely a scam.
You're 100% right. Unless you own a business, you have to have a business and a tax liability against the business. For individual taxpayers, IRS doesn't call.
Absolutely.
If you have a business and IRS is calling, stay polite, get their number, get their ID, and then ask them to email or fax or mail the information to you. Give them the fax number, give them your address, verify the address. Instead of you giving them the address, ask them to verify your address. So try to give limited information. If they are really IRS, they should have your address in file. They should have your name, address, social security number. A lot of times these IRS agents, the scammers, they will try to verify, give me the last 4 digits of your social. Where do you live? Just don't fall for it.
Yep. Okay, very well. Now let's continue our topic, IRS tax audit. High income levels, that's where they really need, they target those high income level people. So AJ, tell us, what should the high income level individuals do in the tax return to avoid the audit?
So statistically speaking, higher the income, higher the audit rate for the IRS.
Chances are high.
Chances are high, and if you look at the actual statistics, if you look at the actual audit rate, you will find the people in the higher income, people who are making more than $1 million, have up to 8% audit rate. People who are making more than $200,000, they have up to 4% audit rate. People have who are making less than $50,000, they typically have less than 0.5% audit rate. What we are saying is, more income you have, more potential audit probability you have. So you have to be careful. You have to know, you have to make sure you're reporting everything. If you have foreign transaction, if you own a company here, your US company owns an Indian company, meaning if you have complexity in your situation, consider filing an extension, consider getting all the information, make sure you download a tax transcript, and more complex the situation you have, lesser the reason you have to do it yourself. Try to find a competent accountant who is familiar with your type of situation and let them file it for you.
Okay. All right. The next item that I know is the large charitable contributions.
Absolutely. So charitable contribution is a sacred thing. IRS allows up to 60% of cash charitable contribution and up to 50% of non-cash contribution. There are a lot of plans where you're allowed to donate certain rights. Let's say, for example, if you have a property and it's on the highway and the state doesn't want to construct this property, you can give up the right of construction. If you have a historical property, you can give up the right of construction on your historical property. In those cases, you qualify for non-cash donation, but those things are highly scrutinized. Take an example. In your income level, if every year you have been claiming 5,000, 6,000, 7,000 of donation, and suddenly your donation is 50,000, you better provide the receipts around it, especially if it's a non-cash donation. The worst part is a lot of people send these used clothes to Red Cross Society, and a lot of time they will just give you the receipt. They don't have the proper appraisal around it, and people are filling up those numbers themselves on the lupus receipt, on Red Cross Society receipt. So just be careful what you're claiming, and if the number seems out of proportion based on your history, based on your prior tax return. In those cases, it's common for IRS to be asking for the proof. Remember, all donation, all such proof receipts must be contemporaneous in nature, meaning you cannot say, I know the Panditji, I know the temple. If the need be, I can get the receipt. The receipt has to be there with you at the time of filing.
Yep.
Otherwise, you should not be claiming the expense.
All right. The other two areas where the taxpayers find it really, really good to take advantage of it. One is the business expense, and the other one is a home office deduction.
Absolutely. So people get carried away, especially when it comes to the home office expense or single member LLC, which goes on Schedule C. The the best part is you don't have to have a business to claim business expense. Meaning you can have intentions to open a business, you can be trying a new business without forming the proper LLC. Legally, you are allowed to put those expenses on Schedule C. C as in Charlie. But remember, Schedule C is the most audited schedule in IRS records. So when you are claiming any expense on Schedule C, you have to be careful. You are adding potential audit in your situation. Home office expense is extremely tricky. You have to see how much of the space you are using. Is it used exclusively and consistently, regularly? Meaning you can't really say, I have an office table in my bedroom, and that's why I want to claim the home office expense. That's not how it works. It has to be a separate area, separate window, no bed. And then you have to see how big of this space. Let's say your total house is 2,000 square feet. And this space that you have, this separate office exclusively, is 10 by 10. Then 10 by 10 is 100 square feet. Then you can claim 5% of the other expenses for your office. The worst part, when you sell the home, the percentage of the home that you are claiming as a business expense, that part becomes a taxable transaction for you. Remember, when you sell the primary home, the first $500,000, married filing jointly, first $500,000 of gain is non-taxable. But if you have been using the home for business, in this example 5%, then 5% of the capital gain is going to be taxable. So you have to be careful what you claim and look at the repercussions of what you are claiming.
Okay, very well said. With that note, we're going to take a break. And viewers, when we come back after this messages, AJ is going to touch upon more IRS tax related issues, which you don't want to miss it. So stay with us. We'll be right back. Hello and namaskar viewers, welcome back to the second half of the Tax Talk with AJ, and today's topic is really interesting. Today we're talking about IRS tax audit. Let's continue our conversation. IRS tax audit. Before the break, AJ touched upon some of the issues that what triggers IRS tax audit. We'll continue that conversation, and also AJ is going to tell us how to avoid IRS tax audit. Obviously, you cannot avoid IRS tax audit by not filing your tax return, right? That's not the way
absolutely
to
not.
avoid it.
Absolutely not. If you don't file it, sooner or later, IRS will catch up to you. It's a matter of time only. So the IRS has 6 years to get back to you from the date of filing. But if you don't file, that 6 years is not starting. Meaning if you file 3 years late, they have 9 years. So unless the filing is done, the clock is not starting. But before we go back to our IRS audits, we want to let our viewers know that now the gold buying has no restriction. Prior to 1974, people were not allowed to buy any gold. The gold ownership was illegal between 1933 to 1974. Even now, if you are importing gold over $10,000, you are supposed to let the custom know.
Okay.
If you are buying gold over $10,000, we see it as a reportable transaction. The jewelers will report this transaction as a cash transaction. We still see gold as a form of cash. So if you are buying gold for more than $10,000, that transaction will automatically, without you knowing it, be reported to Treasury.
Well, without you knowing, in a sense, when you purchase that from jeweler takes all the information, and once they take information to add into system, it immediately goes to IRS.
But they just CTR around it. It's more like cashing a check of 10,000 or more, or paying somebody more than 10,000 in cash. There is a cash transaction report that they are supposed to file automatically. The system is supposed to file, and a lot of jewelers file this CTR if you are buying more than $10,000 of gold. Wow. But there is no limit on the amount of gold that you can own now.
There's no limit. Yes, true, AJ. Gold has become a very attractive commodity, and so is silver. Silver is also doing very well. So these are the two very interesting commodities. Anyway, let's come back to IRS tax audit. How to avoid IRS tax audit in the real sense?
So just be careful. Report everything. And you say, a lot of people ask us, what's the limit on donation? What's the limit on medical expenses? IRS is not comparing your file with your neighbor's file. IRS is comparing your file with your file. IRS has history on you for multiple years. So just be consistent. Don't go out of your way. Make sure you report all the income. More income you have, higher the chances are there for your audit. More income you have, more reasons you have to hire somebody to do the right thing. More complexity you have. Let's say if you have a lot of companies, lot of K1s, oil and gas investment, preservation, historical society type of investment, more complexity you have, please find somebody who knows what they are doing. If you have foreign transaction, you have to have somebody who understands the foreign transaction. You need to file the FBAR, FATCA. There are huge penalties if you have gift given or gift taken. Make sure you are reporting it on separate forms. There is a separate form 709 that you are supposed to file when you have gift given or gift taken. Please remember, gift filing belongs to giftor, person who is giving the gift, not the person who is receiving the gift. But make sure you're keeping it clean, keeping it sane, and then keeping every number in the limits based on your situation.
Oh, wow. If somebody gets a $400 million jet, would they be paying a tax on it? It's a gift.
Well, again, the US system says the gift responsibility belongs to giftor, the person who's giving the gift, not the person who's receiving the gift.
Okay.
So, in theory, I'm not advocating the transaction. I'm not saying this is the right thing to do. But in theory, if somebody is receiving a plane for $400 million, the person who received the gift has no gift filing obligation.
Even though it's a president of the country, and then after that they're going to use it for personal use, still no taxes?
Personal use or business use has nothing to do with it.
Nothing to do with it.
And at least in theory, being the president or not being the president has nothing to do with it. But I mean, again, who am I? I'm a small-time accountant. The way I see it, receiving the gift is not a taxable transaction.
That's your modesty to say that you're a small-time accountant. Folks, he's not a small-time accountant. He's a very, very busy professional CPA, manages Sai CPA services with almost 100 employees here and in India, and does, tackles all the difficult, complex tax matters when it comes to corporate and a personal. Let's continue this. AJ, there are a couple of very hot, pointers that I really want you to shed some light on it. Quickly, we're going to move on to it. One of the things IRS, to avoid IRS tax audit is aggressive and undocumented documents, right? Do not even try to go in there, and don't try to, be smart and put those expenses.
Absolutely. So if you have an aggressive tax stand, make sure you have the proper documentation around it. You don't want to have a claim on your tax return that cannot be justified. More aggressive the claim is, let's say if you are claiming captive insurance, or if you are trying to amortize the fertility of the land. Land typically is not amortized. But the fertility of the land can be amortized if you have the proper report. If you can justify that I have a farmland, this farmland is fertile, but this fertility will go away in 5 years, and you have documentation around it, then you can claim an amortization against the fertility. If you have historical preservation property that you are trying to give up the right to construct, and now it's a non-cash donation to the township, make sure you have proper documentation. Somebody certified in their field is giving you this documentation that you are claiming on your tax return. More aggressive the tax stand you have, better documentation you need to justify it.
Okay, very well. Quickly, we're going to go on, like I said, touch upon some of the important issues. One of the main reasons to avoid IRS tax audit is they say, use a tax software or use a professional. But let me just tell you, you can use a tax software. No one says no to you. Obviously, you don't want to use an accountant. You can use a tax software. But tax software will always not tell you what are the legitimate deductions that you can get depending upon your income and a tax bracket and all the scenarios. And especially if you and a spouse are in a high earned income category, then strong suggestion is to use professional. It's just a fraction of a cost that you're going to be paying to the professional accountant, but at least they will review it, and at least you will be able to get the deductions that you are eligible for to save tax liability. Am I right, AJ?
100%. There are two different issues. So using a tax software is a very good idea instead of doing it manually. Instead of trying to use the pen and paper to do the taxes, Using the software will help you do some calculation automatically. But at the same time, tax software, most of these softwares are question based. They will ask you a question, you give the answer. But they don't really know the consequences. Let's say if you have a business and then you have a home office, what expenses are claimed? You went for meal, is it claimable or non-claimable? You are deciding it. The software is not deciding it. Software is say, give me the meal expenses, and you are putting in a number. But that meal expense should not be claimed because that's your meal. You would have eaten anyway. So software is guiding you, and based on your information, based on the decision that you are making, software will try to calculate the taxes. So software is better than doing it manually. But if you are in high earner income bracket, please try to use professional help.
Absolutely. It's always a good idea to use professional tax account, especially, if you're in a high earned income category. That's always a good. And the other good thing is you must separate your business and the personal finances.
100%. You don't want to be commingling the funds. If you commingle the funds, then we don't know which expense is business expense and which expense is personal expense. Even if you don't qualify for a business credit card, a lot of times the new business owners do not qualify for a business credit card. So they end up using a personal credit card for their business expenses. Even then, keep one separate card for business expense only. Do not have the same credit card used for personal expenses and business expenses. We see that situation a lot of time with car. They have one car which is under their name. Just because part of the car or part of the travel is done for the business, they try to push the whole car's lease expenses into the business expense. Just try to avoid those type of situations.
Absolutely. And the last but not the least, when we have about a minute and a half to go into AJ, let's talk about staying current on the crypto and the foreign asset rules. That's really important.
Absolutely, Sanjeev ji. So cryptocurrency transactions are now reported to IRS. If you have any exposure to cryptocurrency, please make sure you're reporting it. It's not difficult. It's like any other stock. You have the capital gain, you pay the capital gain taxes. If you have capital losses, you claim the capital losses. But if you have cryptocurrency, the problem with cryptocurrency transaction is a lot of people feel that nobody will find out. And that's not true anymore. For last 2 years, IRS is getting the cryptocurrency transaction directly reported into the system like any other 1099. So please try to stay on the right side of the law. You don't want to be found that you knew about it and you did not do the right thing.
Absolutely. Thank you so very much, AJ. With that note, we come to an end of this week's episode, the Tax Talk with AJ. But in the end, a very important message I want to share it with you is that now we are, getting into month of November. By the time you watch the show, November will be here and November will be coming. But now we are in November. Let's assume. So we have November and December, 2 months to go into this year, 2025. Please look at your taxes right now. Look at your income, the possible income by the end of the year, and then your finances and everything else, because this is the time where you can invest money in one of those plans where you save on your tax liability, not the refund. Refund is something different, but the tax liability. So if you really invest money in one of those plans which are authorized by the government, approved by the government, you can reduce your tax liability. So do pay attention to that matter. Do not avoid it, that you can only do it till end of December. But why wait till end of December? You must contact Sai CPA Services now, 908-888-8900, or visit their website, saicpaservices.com. They'll guide you, advise you, and also suggest you where you can invest the money. So it's a time right now to look into it, few minutes, few hours, a day or two. It will really, really help you to save your tax liability. AJ? Anything to add to that?
Absolutely. If you are in New Jersey, November is here. We have the election week this time. Please go out. Make sure your vote counts. You owe it to yourself. This is your responsibility. This is your right to vote for the right candidate that you believe in. So with all that, please give us a call if there is any question, and we'll be happy to help.
Sure. A good reminder for vote. You must go out and vote. Until we meet again, same place, same time. I'm Sanjeev Pandya, wishing you all happy and the tax-free days ahead. AJ, once again, thank you so very much for your time.
My pleasure.
Right.
Thank you.
See you all. Take care. So long. Namaskar, viewers. I am Sanjeev Pandya welcoming you to this week's edition of the Tax Talk by AJ right here on ITV Go on your favorite TV channel. The show is brought to you by Sai CPA Services. You must have heard by now. Sai CPA Services is one of the most professional and very, very thorough, detailed CPA firms in the state of New Jersey, multiple locations, and they can assist you with any tax matters, your personal tax matters, if you're a business owner, your corporate tax matters, and they can advise you and guide you on your taxes as well. They can help you with IRS tax audit. So that's the Sai CPA Services. You can give them a call at 908-888-8900 or visit their website, which is saicpaservices.com. With that note, I'd like to welcome Mr. AJ Kumar of Sai CPA Services. AJ Kumar is a CPA, CVA, and MBA, and he's been part of Sai CPA Services with over 25 years. Every week he joins us in the show to guide us and to inform us about the tax rules, regulations, and the more details on the taxes matter. AJ, good to have you.
Thank you, Sanjeev. Thank you for the kind introduction.
Yes, absolutely. You're most welcome and you deserve it. Now, viewers, before we begin this show, I want to tell you one thing about this country. This country is obviously, there are two important things in this country. One is immigration. The country is built on immigrants, and the country is very, very competitive, very aggressive in the innovation. United States of America, the prosperity of this country has been strongly rooted on innovation, innovating new products, whether it's a technology, whether it's a household things. So innovation is a very competitive landscape in the USA. I remember reading an article somewhere that they get so many requests about innovations, new products here and there, and they just have to go through it to see which one can work, which one cannot work. The reason I'm saying innovation is because that point leads to R&D, research and development, because once somebody has an idea about the product that they wanted to invent, obviously then R&D follows. And how that R&D and innovation can be added, included, offset in the tax return, that is the key thing. So we're going to highlight corporate tax returns and R&D and innovation tax matters in those tax returns. Right, AJ?
Absolutely. If this country is known for anything, it's for bringing the brain here through immigration, through other channels. And then this is the country that's leading the whole world in research and development.
Yep.
And the country promotes it. The system, the IRS system promotes it. There are a lot of credits, a lot of benefits that are made around encouraging companies to do more R&D. And that's what we are going to be talking about.
Absolutely, AJ. You're going to tell us, the R&D cost or the innovation cost, how are they reflected on the tax returns? What kind of benefits the companies get when they invest heavily into research and development? And this is all to encourage those companies to come up with a product, invest in research and development, and then come up with something else. And that's what government is really offering them incentives. So let's start with the R&D. If company has R&D department, how does that matter with the taxes?
Absolutely. Let's first define what the R&D means. And then we see it doesn't have to be a department or separate department, for example. So research and development means you're researching something new or trying to improve something. Expenses related to that exercise are by definition R&D expenses. Now take an example. You are running an IT consulting company or a staff augmentation company where you have few people on your staff and you're hoping the client will take it. But sometimes not every employee is assigned to a client. The client have not taken them. And we call it bench strength. There are people on the bench or who are trained and waiting to be placed on the client side. So a lot of IT consulting company will use the bench strength to create something new, a time sheet system or a performance tracking system or a KPI tracking system. And these softwares, these intangible assets can be then further sold to other clients. So they're trying to improve something. They're trying to create a new software, new system while they are not using the staff. So in that case, you can use that expense, not just the staff salaries. If you had to outsource some work to somebody, 65% of that amount. If you have a separate room, rent for that area. So it's not necessary for the companies to have a separate R&D department. In pharma companies, you always have a separate R&D department. It's easier to justify in pharma companies, in medicine field, but even in the IT consulting, even in the AI field, while you're trying to develop the next application, trying to find the next idea, you're researching a lot and you're spending a lot of money until you hit that gold spot. All those expenses can create a tax credit, tax benefit. They're just not an expense only. Of course, they're business expense, but then there is a tax credit angle to it. That's what we want to bring to your attention.
Okay, so when there's a tax angle to it, obviously that's a good point to know. Are there any limitations on the amount or the percentages? And now that does it really help the company to reduce the tax liability, or it's an incentives that they are getting it which reduces their taxable income?
Both. If you play it right, you can not only reduce the tax liability first, and then whatever the leftover amount of the R&D expense is, you can use that R&D expense, the leftover amount, to reduce the taxable income. Meaning, you cannot use the same dollar for R&D credit and R&D expenses. But first claim the R&D credit. Take an example. Say, for example, you want to calculate R&D credit. So in this example, let's say you invested $100,000 on all the R&D related work. And again, the outsourced work is 65%, in-house, including salaries, is at 100%, and it has to be domestic, not international. And let's say this number for this example is $100,000. So out of this 100,000, you can choose two methods. You can choose an easy credit method, or you can use the regular method. In the easy credit method, you generally get about 14%. So in this example, you get $14,000 of R&D tax credit, which will reduce your tax liability dollar for dollar up to $14,000 in this example. The remaining $86,000 can still be claimed as an expense. So the idea is most people will put the R&D as an expense on their P&L. And a lot of people are doing it and they're saving the money. But they're missing almost 10% of the credit. Let's say if you put $100,000 as an R&D expense, if you are in a 20% tax bracket, you save $20,000. But if you take $14,000 as a tax credit first, and then use $86,000 at 20%, you got another $17,200. So you got $31,200 of tax credit as opposed to $21,000. So you save almost 11% extra in this example. Higher the income slab, more savings you will see. The idea is first see if you qualify for a tax credit, and then on the leftover amount, you try to claim it as an R&D expense.
Okay, interesting. So when you sit down to do a tax return, I assume that what you do is that, okay, let's see with the expenses, see what the tax number comes out, right? And then without the expenses, going to the tax credit to see which one benefits most, and then you take that option. And in some cases, maybe expenses work out better. Otherwise, in some cases, tax credit.
Well, unless the R&D expenses are really low and
expenses are high.
I'm sorry, the other way around, if you think about it. Unless the R&D expenses are really low, in the sense, let's say if the total R&D expenses are $10,000, and to create this paperwork to justify the R&D tax credit is going to cost you $5,000. There are special companies, there is CPAs who will do this R&D tax credit calculation for you. They will create this form 67, 65 for you. And that is an expensive process, cost few $1,000s. So unless the saving justifies that documentation, it doesn't make sense for you to do it. The only time you wouldn't consider claiming the tax credit when your R&D expenses are just very low, not high enough to go there. But generally speaking, if you have 10,000, 20,000 plus of R&D expenses, you should look at the R&D tax credit first.
Okay. All right. So now, with that note, you mentioned one thing. It has to be all domestic, nothing overseas, right? That cannot be taken.
Well, no,
on a tax
domestic
return.
can still be claimed, but domestic R&D expenses can be claimed immediately and can give you an R&D tax credit. If it's international R&D expenses, outside this country R&D expenses, they have to be put as a capital asset on the balance sheet and they must be amortized over 15 years. Domestic credit still have the option to be amortized over 5 years, depending on how much income you have and depending on what tax bracket you fall in. If you're a growing company and you don't have any income to offset, maybe you don't need the R&D expense or R&D tax credit. You can choose to have R&D amortized over 5 years for the domestic R&D. International R&D doesn't give you that option. International R&D expenses must be amortized over 15 years.
Okay, very well. So now, having heard R&D tax credit and R&D expenses, how they reflect on the tax forms, that's what we have gotten so far. With that note, we're going to take a break, and when we come back, we're going to take this discussion further, go a little deeper in R&D. That what are the expenses covered under R&D? Because it just the name says research and development, but there are a few categories. What's to be deductible, what can be included, what not. That's all coming up right after this messages. Stay with us. Welcome back to the second half of the Tax Talk with AJ. This weekly show, as you know by the title, that's all about tax discussion. Discussion on the taxes for your personal or corporate tax matters, and AJ gives us all the important guidelines that we really need to know when it comes to taxes during the season, off season. It's not like once the taxes are filed April 15 through October 15, there's no tax talk. No, there's always something to talk about taxes, and that's what we discuss. Right before the break, AJ told us about R&D tax credit and R&D expenses, which reflects, one of them reflects on a tax form, but each and every single company's R&D department, their situation is a bit different. Now, to take this task further, my question to AJ is that what's included in R&D? Of course, R&D, when we talk about R&D, we visualize a big facility, many people working in there, there are a lot of supplies, and of course, there's a payroll, meaning wages involved, and supplies involved, and the building cost, and everything else is involved. So, how does that work? You take the sum of all those categories and put it on a tax return, or you can only take percentage of certain categories?
A very good question. So for R&D expense, everything is a fair game. Anything that you can think of is a business expense related to R&D is acceptable. When it comes to R&D credit, there are certain limitations around it. But I want to remind all our viewers that as much as when the word R&D comes, we think about the IT companies, we think about the pharma companies, but R&D is not limited to IT companies and pharma companies. R&D could be anything. You are making a flute, and this is better than anything else you have seen. Meaning R&D is not related to certain sectors only. But when it comes to the credit, not the expense, R&D credit is limited to the wages, meaning the salary of the employees who are working on the R&D, the supplies needed for that particular part, especially the external R&D. If you are taking any help from people who are not working for your company, the external help, that's limited to 65%. Wages, 100%, supplies, 100%. But going back to your example, Sanjeevji, if you have a building, can you put the depreciation of the building as an R&D for credit? That's not allowed.
Okay.
So R&D credit has certain limitations. R&D expense allows everything.
All right. So whatever the limitations are there, and that is for the all kind of categories, meaning there's a technology, there's a pharmaceutical, there's even for, let's say, to make a piece of furniture, there are R&D involved, right? A piece to manufacture a musical instrument, R&D involved.
Absolutely.
So this 100% wages and the supplies and everything, that's for all the categories, right? It's not like only certain category gets something.
Absolutely. For R&D credit, It's limited to certain expenses, but those expenses are not limited to a particular industry. It's applicable to all industries.
Okay. Now, having said that, what about R&D expenses? How
So
do they
for R&D
calculate it?
expenses, the advice that we are trying to convey in this show, we want all our viewers, if you have a business, if you have R&D expense, try the credit first. Whatever is not claimed in the credit, all those expenses can be claimed as an R&D expense 100% on your tax return if it's domestic R&D expenses that you have. If it's not domestic, then you have to amortize it. You have to put it on the balance sheet and amortize it over 15 years.
Okay, so balance sheet and okay, now the question is amortized for 15 years. That means if the company has R&D department, ongoing department, for example, I'm just hypothetically speaking, right? Let's take a Johnson & Johnson. And they're a big company. They continue to do R&D research on different drugs and medications to see which one works, which one not work. And they have ongoing this R&D department. So take that company, for example. So every year they will have this kind of expenses on their corporate tax return, right? It's not like they can only do it certain amount for so many years and after that it cannot be done.
Well, there are two parts to it. For big companies like Johnson & Johnson, when they have a separate R&D department, they have something going on every day, all the time anyway. And when they're working on something, not everything is a proven project. They're trying to find the new medicine. They have to try 50 different things to make something work. So R&D has to be a proven concept that you're trying to develop. A lot of times, until you know that this is proven, this cannot be amortized. So you keep collecting all the expenses in a bucket. Once you see that this is proven, now this you can have a second version, an improved version. Let's say if you're developing software, it could have version 5, then you can have version 6, version 7. But while you're developing it, you cannot amortize it. It has to be a piece that's usable, that can be put in service in order to qualify for amortization.
Okay, all right. Okay, having said that, let's go a little more further. I want to bring in this angle. One big beautiful bill act known as OBA, OBBA, right? Has anything changed for the year 2025 under that OBA tax thing?
Yeah, absolutely. So OBA is allowing the 100% reduction. Prior to OBA, when we had Tax Cut and Jobs Act, that set 5 years amortization even for the domestic R&D. So there are a lot of changes that OBA is bringing, a lot of benefits for make in US type of idea, do more R&D locally, domestically type of idea. So they are not touching. Under the TCJ, Tax Cut and Jobs Act that came in 2017, international R&D was still 15 years. They did not touch that. It was 15 years. Under OBA, it's still 15 years. But the domestic R&D that used to be amortized over 5 years can be expensed immediately 100% now.
Okay, interesting. Now, for a moment, let's just go on a sidetrack a little bit. Personal tax returns. If somebody comes up with the product, somebody thinks of some product, and they do their own creation in their garage. I'm just using that example. And they spend X number of money on their, of course, their own payroll, their own hours rather, and then supplies and everything else. And it's just a personal tax return. They are not sure what to do, what not to do, but they want to see that if product really is developed, then they can take it further. So the money spent and the hours spent and all the resources and everything in the garage for that individual, for the individual, would that reflect on their own tax return?
It can, it should. But you have to be careful. This area can be misused by the system, by the taxpayer. So you have to let the system know it's not a hobby. Meaning, hobby losses are not deductible. While you're developing this product, you're not making a lot of money out of it. So more than likely, you want to claim the expenses without any revenue. So you want to claim some tax deductible losses over there. So first step is to justify that it's not a hobby, it's a real business, real product that you're trying to develop by forming the LLC, by having a separate space, by having a website, by having the business card. Justify to yourself, to the system, that it's a legitimate business, not a hobby. Once you have crossed that road, that is not a hobby, it's a legitimate business, then you have to keep proper documentation. What you can claim is the money that you're spending. You can't really say, I spent 10 hours, I should be getting $10 an hour, so I spend $100. The time value of money is not a deductible expense. But anything out of pocket, you can't really say, I'm using the garage, so I want to claim the rent for it. Then we'll say, who are you paying this rent? Oh, to myself. It becomes taxable income to you then. Then it's a wash. It's not adding any value. So home office expenses are limited to $5 per square feet up to 300 square feet. And then it needs a lot of documentation. If you're just starting up, keep it clean, focus on out-of-pocket expenses, don't include the time value of money, and make sure you justify to the system by proper documentation, by having the LLC, having a website, or having the business card, having membership to some networking groups. That is a business. It's a legitimate product that you're trying to develop. It's not a hobby.
Okay, all right. We got now literally a minute left in the show, and I have one quick question. You mentioned startup in your answer. So if there is a startup company and they really believe in this product and everything is going well, right? So my question to you is, when there is a startup company, do they directly can come to you, or they really need to go to a professional R&D professional to have some kind of report done which you can use it in order to prepare their tax return?
Well, it's a different field. We do R&D expense, R&D credit reports. Not all CPAs do. So if you are going to your CPA and your CPA is advising you that they need a third party, you can always hire a third party. But there are a lot of CPAs who will do that work as well, meaning who will go through the paperwork, who will help you understand, justify. A lot of payroll companies do it. All payroll companies, the big ones, you can call them if you have the payroll with them, because the biggest expense in the R&D credit is the wages, is the salary. People who are doing this R&D, they are typically highly paid people, high salaried people. So the biggest expense happens to be the wages, the salary. A lot of payroll companies started to do this R&D credit as well. Okay. So you have a lot of options out there.
Right. Okay, so you have options available. But having said that, of course, you heard from AJ that they do it. Sai CPA Services can do it for you. And that's why I'm saying that they are the most knowledgeable, full-fledged professional accounting firm located in state of New Jersey. If you're not in New Jersey, if you're outside somewhere in the USA, don't worry. They can assist you with the Zoom call or over the phone, or anything is possible. So do reach out to Sai CPA Services for this matter or any other tax-related matter, 908-888-8900, or visit saicpaservices.com. With that note, AJ, thank you so very much.
Absolutely, my pleasure. Thank you.
All right. And again, I'm Sanjeev Pandya, wishing you all happy and the tax-free days ahead. So long. Viewers, I am Sanjeev Pandya, welcoming you to this week's episode of the Tax Talk with AJ right here on ITV Gold. The show is brought to you by Sai CPA Services, a fully professional accounting firm located in the state of New Jersey. Multiple locations, so they can assist you with your personal and corporate tax matters. Even if you're in the USA, anywhere else, they can be reached at 201-888-8900. That's a 201-888-8900. Visit their website, saicpaservices.com. For any tax matter, personal, corporate, or even IRS tax audit, and if you are in the small to mid-sized business, they can help you with virtual CEO, CFO, and the payroll assistant and bookkeeping services. That's what Sai CPA Services is all about. They believe in two things: to do the books right, and when you do the books right, pay your taxes right, and whatever the deduction you are entitled to, you must get. And that's why Sai CPA Services has been helping hundreds of thousands of clients every year. So do reach out to them, 908 888-8900. That's a 908-888-8900. Visit SaiCPA Services.com. So once again, for any tax related matters, remember Sai CPA Services, they have been helping hundreds of thousands of clients over the years, and they can assist you. All you need to do is give them a call at 908-888-8900 or visit SaiCPAServices.com. With that note, I'd like to welcome Mr. A.J. Kumar, CPA, CVA, and MBA with Sai CPA Services with over 25 years of experience. Every week he joins us, guides us, informs us all the taxes related matters. AJ, thank you so very much for your time. Thank you for joining us once again.
Absolutely, Sanjay. Thank you for the kind introduction.
You're very welcome. Now, AJ and all the viewers, we all know right now, the word that we hear either when we're watching a news on TV or even if we are reading a newspaper or article or anything, right? One word circles around us, and it's been going on since last several months, and which is tariff. What exactly, you all know what tariff is, but tariff and taxes, how are they related? Because tariff has been a one tool which is part of any country's economic. In the excessive percentage where it's really hurting the consumers to buy the products because of high tariffs, then it really makes things very complicated. In a way, the country gets a revenue, but at the same time, the cost of living goes high. It impacts economy also. So today we're going to discuss that subject, and AJ is going to guide us step by step, A to Z, when it comes to taxes and the tariffs. So, AJ, my first question is, what exactly is the role of tariff to the policy?
Absolutely, Sanjeevji. So we'll be explaining what tariff is and how the tariff works, what the tariffs are for various countries. Then we'll look at the whole situation from the tax angle. We'll look at the tariff situation from tax perspective. And then we will remind our viewers, of course, that 15th October is the tax deadline for your personal taxes,
Yes.
for the C corporation taxes. If you filed an extension, make sure, please, file your taxes by October 15th. Even if you have just estimated information, even if you don't have the right information, you have the right to amend your taxes for 3 years. So file the best possible tax return. If the need be, you can always amend it. But let's come back to tariff. When we say tariff, tariff is a surcharge. It's a tax that's levied upon imported items. So when the U.S. government, as a country, imports certain items from a foreign country, and let's take an example of India. Now we are talking about 50% tariff from India. So all the crackers, the biscuits, namkeen, rice, basmati rice, all that comes from India. So if you were buying basmati rice for, let's say, $1 a pound, it's going to be $1.50 a pound, because people who are importing the rice, they have to pay 50% tax to the US government. So why would the government want to do it? Mainly for 3 reasons. First, government wants to make sure the import is not happening. People should be using the local product, not the foreign product. Second, generally, we want to create more revenue and a source of revenue, another source of revenue where the government funding can happen. So this funding can be used to lower the taxes, to create more roads, to create more infrastructure. And the third section that typically we use tariff for is to balance the import-export. In case of US government, we have a lot more import than what we have in export with most countries. So not only tariff, if implemented right, can create another source of revenue, can increase homegrown products, and also it can balance, or it can help to a certain extent in balancing the import-export gap that we have with many countries. So moving on to how tariff works now. Let's say tomorrow this basmati rice is not $1.50, but it is $1.50. Who is actually paying for the tariff? The problem is the consumer end up paying for the tariff. It's not the business. Business who is buying in this example, basmati rice for $1, If tomorrow they have to pay $1.50, they are going to pass this cost to the consumer, to the end user. Businesses cannot afford to pay 50% extra. There is not enough margin to absorb 50%. So ultimately, if the tariff was 5%, it would not have impacted the economy as much. But when we increase the tariff to an extent of 50%, 100%, then everything in the economy becomes expensive. Food becomes expensive. Now people have limited income. So when food becomes expensive, they can't afford. So the minimum wage that used to be $15.50 has to be increased. When the minimum wage increases, because people cannot afford the food, then the payroll cost increases for all the businesses. When the payroll cost increases for all the businesses, they have to increase the price. So it becomes a ripple effect. It's not just, it does not end with food price increase. Everybody will start charging more money, and it creates a situation when the poor people gets even poorer. Richer people, and richer, let's say top 1%, those people will get even richer because they can use this as an opportunity. Take an example. If somebody is sitting on large inventory, make it the food inventory, gold inventory, jewelers, when the price increases by 20%, 30%, 40%, they are not buying this inventory now, they are sitting on this inventory. But now they can sell this inventory at a higher price. So the richer people, the rich people will get even richer, make a lot of money. The poor people get the burnt, they are paying the tariff, and the benefit that they were expecting. See, the promise was this tariff will be used to create infrastructure. This tariff will be used to lower your taxes. But that has not happened yet. President Trump promised the corporate tax rate will be reduced from 21% to 15%. Will eliminate IRS. There wouldn't be an income tax. We'll have ERS, external revenue source, no IRS, no internal revenue service. But that has not happened yet. That can take months, years to happen. Until that time, you have the IRS, you have the higher income tax, you have the higher corporate tax, and you have tariff on top of it. So it becomes a double whammy for a lot of people, especially in the lower income tax bracket. Tariffs can create a bigger problem than more richer people.
Well, it has created bigger problem. AJ, after listening to you in your opening remarks about tariffs, obviously some questions come to our mind, and we would like you to clarify those questions. And our viewers may have come to know a lot more about tariff, but let's just talk about basic stuff. So any viewer, hypothetically speaking, anyone can understand what exactly we are discussing here. According to Penn Wharton study, first of all, they say that President Donald Trump's plan on this tariff will add $5.2 trillion in the country's treasury over 10 years. Okay, so that's one thing. Now, our federal deficit is $3.9 trillion, something like that. Now, you mentioned, you said that everything goes up, including the minimum wages and payroll and everything. Not to forget CPI, Consumer Price Index goes up, inflation goes up, interest rate goes up. So all in all, a regular consumer is going to suffer. You say corporate, if somebody has $1 million inventory 3 months ago, and now the inventory is valued at $5 million, of course he's benefiting. He's paying the same amount of taxes, or they have some loopholes where they can save the money on the taxes, right? So they are okay. It's the end consumer who's going to be feeling the heat, and everyone is feeling the heat right now. So my question to you is that, when you say the taxes should have been lower, taxes have not been lowered. Yes, maybe there are some deductions here and there that President Donald Trump introduced in his big, beautiful bill, all right? But it really does not offset the tariff cost, because every day you're going to need food items, every day you're going to need clothing items and essential items that you need to live on, right? Even tariff has gone to some of the automobiles that comes to in our country from different countries overall. So this has done. My question to you, number, is that President Donald Trump imposed this tariff on certain countries. It's out of rage and out of anger, or to satisfy his ego. is it really permanent, or any president who comes in after that can change the policies?
Well, I believe any president can come and change the policy, prior policies. We have seen it happening earlier. I do want to state that the current tariff has been challenged in the court. We are expecting another hearing from the Supreme Court in November.
Oh, good.
That can change the tariff situation. New government, whenever the new government comes in, they can always change the tariff. And I wouldn't really say it's about ego. I wouldn't really say President Trump is doing it to punish anybody. The way I see it, President Trump is doing the right thing in his own mind. The way I justify the stand, the modus operandi has been you increase the tariff by absurd amount of money, 100%, then both countries sit together and agree on 25%. And that's how President Trump is seeing it as a win-win. Take an example. If you go out and tell any country, Japan, hey, your tariff is 15% now, they wouldn't appreciate it. They will not like it. They will give you a hard time.
Oh, out of ego. The reason I say out of ego, because for certain countries he didn't have to impose. Listen, for example, India, 25% tariff. I can understand that. What was the reason to add extra 25%? He mentioned that reason. We're not going to get into it because it's not a political show. It's a tax talk, right? Additional 25% only in India was unnecessary, uncalled for. Now, before we go into the break, I just want to mention one thing. President Donald Trump, during his campaign, he promised that once he becomes president, he will lower the cost of living. He will bring down the prices of milk and grocery items, because if you remember, in the previous administration under the President Joe Biden, things were very expensive. Interest rates were high. Inflation was high. Fed could not cut down interest rate, not even at 25 basis points. Last 2 years been very, very difficult. And President Donald Trump promised middle-class Americans that I am going to reduce the prices. Your grocery is going to be cheaper, milk is going to be cheaper, rice is going to be cheaper, eggs is going to be cheaper. It didn't happen, AJ, and that's why I said somewhere along, unnecessarily, uncalled for reason comes in. If that reason, if I say your ego and you say no ego, whatever it is, it's okay, but it's unnecessary, uncalled for. With that note, let's go and take a break, and when we come back, we're going to continue this conversation, tariff along with taxes in a country's economy. We'll be right back. Stay with us. Welcome back to the second half of the Tax Talk with AJ. The weekly show brings you all the latest that you really need to know about taxes and taxes-related matters. Before I go any further, viewers, want to remind you in my powerful voice, October 15th is the tax deadline. After that, there is no more tax deadline. If you have filed an extension, hopefully you did, then make sure whatever the taxes you need to pay, whatever it is, just file it by October 15th, send the payment. If not, then talk to IRS. They will set you up with the installment plan. But October 15th is the last date. So do remember that. And if you have any question, need some clarity or something like that, or need assistance, this is the time you should be calling Sai CPA Services, 908-888-8900, 908-888-8900, or visit saicpaservices.com. Book an appointment and ask them that you want to see Mr. A.J. Kumar. Immediately, your phone will be answered, your meeting will be scheduled, your problem will be solved, because I say so. Coming back to our topic of the show, tariff and the taxes. Right before the break, as I was asking AJ that, President Donald Trump promised during his campaign that he will lower down the cost. He will lower down the cost of household items, including the gas that we use for our autos and everything. Has it happened? Maybe somewhat. Yes, gas is not that expensive. I can definitely confirm that. But when it comes to everything else, it has become expensive. And with the tariff, the other countries where America imports a lot of goods, a lot of essential home goods, it has become really expensive. Now, AJ would like to, add his views to this matter.
No, absolutely, Sanjay. And your observation is 100% right. For the last 2 years, things have been increasing in price. The interest rates were very high. If you recall, last month was the first time over so many months when we saw a 25 basis point reduction in the interest rate. We understand President Trump had a say in that matter. We are expecting interest rates to continue going down in the near future. I understand milk, daily products, food items are expensive right now, but there is a plan in place. Whenever you go through these changes, there is always a phase, a temporary phase. But take a look at OBBA, one big beautiful bill. There are a lot of provisions over there. The total cost of that big bill was $4.5 trillion over the next 10 years. That's a lot of money. That's more than the total deficit we have for the US government. So, how do you create this $4.5 trillion of expense? By giving more money back to the community, by giving more money back to the general population. Take an example. Salt deduction used to be 10,000. It became 40,000 now, if you are making less than $500,000. Standard deduction have been increased. Gift deduction, estate deduction has been increased. A lot of incentives, including 179 depreciation deduction, bonus depreciation deductions have been given to small businesses. There are talks, it's not final yet, there are talks about reducing the corporate taxes from 21% to 15%. So when they reduced the taxes, it creates a deficit. Less money is being received by the government. Somebody has to pay this money. Government is already running in deficit. That's where the tariff comes in. As you rightly said, Sanjeevji, these tariffs are expected to increase $5.2 trillion over the next 10 years. Or even if you lose the CPI inflation rate, at least $4.5 trillion. So there is a plan in place. Not everything has been done right. Not everything has been done the way I would want it to be done. But I truly believe that there is a plan in place. It's not done out of just a whim or ego issues. It's done because there is somebody who wants to do it this way.
Let me ask you a question then. All these deductions that you just mentioned as part of OBBBA, one big beautiful bill and everything, right? How many of those deductions really apply to lower middle class families living in a 1 or 2 bedroom apartments and doing a labor job and buying groceries? It's like they're living hand to mouth, meaning paycheck to paycheck, and buying groceries and taking care of the kids. None of the deductions would apply. They don't know about salt, and they don't know about corporate taxes, and they don't know nothing. All they get, whatever standard deduction they get, that's it. But they are the ones who are putting money into the economy and buying household stuff. Their budget has gone up. It is a fact that they came up with this number that this would cost approximately $2,000 extra per family per year with this increase in tariff.
Well, that's a statistics that depends on how you look at it. Another article that we saw, and we have a YouTube video. Please go to Sai CPA Services YouTube channel. We have a video over there that explains to you who is actually benefited with this OBBA. The way we see it, a lot of these benefits phases out. Say, for example, senior deduction, $6,000 additional deduction that senior people can have if you are over a certain age. But that phases out if you are making more than $150,000. Donation, there are a lot of these benefits. Say, SALT phases out if you are making more than $500,000 married filing jointly. The idea is, say, tips. Over time, there are a lot of benefits that are getting phased out if you are making more than a certain amount of money. What it means is, if you are making lesser money, and lesser is defined as in most cases $150,000 per person or $300,000 per family. If you are making lesser money than that, you are getting an extra benefit. So the bill is actually helping you. Who else is helping? If you are serious rich, corporations, shareholders of these large corporations, then you have Section 179, bonus depreciation. There are a lot of other benefits. So the idea was that middle population, people who are well-to-do or rich enough to afford a lot of these things but not super rich, those are the people who will end up paying more taxes. The bill is helping the very poor people and very rich people. But the middle generation, middle sector may end up paying a little bit more taxes than not.
All right. Okay. Let's say, obviously, the counter argument can continue and continue. I want to look at a different angle right now. When the tariff was imposed on some countries, what if those countries or some of the countries in that group would say, all right, Mr. USA, if you're going to put 50% tariff on my product coming to USA, I'm also going to put 50% tariff on your product coming to my country. What would that happen? Wouldn't that hurt our country's economy, USA's economy?
It can, and that's why you have to balance it out. But the good thing or the bad thing is US is running a trade deficit with most countries. What it means is we have larger import
correct.
than
export. Yes.
So you can put tariff on 50%, but my export is only $100. My import is $1,000. In that case, if I get 10% is more than if you get 100% from me. So in that case, 50-50, even though it sounds equal, but it's not equitable, meaning just because my import is much higher than the export, even with 50%, I'm a winner.
In a higher category, let's say USA is number one in technology. USA makes great automobiles, and their automobiles are very well received in other countries, right? So when their automobile gets expensive, then they're not going to buy, and then obviously US companies, Ford, Chrysler, GM, they're going to suffer. They're going to say, guys, we're not getting orders, even for Boeing for that matter, whatever it is. So in a way, that tariff has to be in a sensible way. If you are putting a tariff, then give lower middle class a break that they can really use it, that they can save the money and they don't feel the pinch in their pocket when they go out to buy household groceries and the regular stuff.
I think that was the intent.
Yes.
It has not been implemented effectively.
Correct. That's exactly what I want to say.
But the intent was there.
Yes.
And not everybody is getting the right benefit.
Yep.
And there will be a lot of people who will see the pinch. And again, it's not as straightforward. We talk about US having the right technology, but who is creating this technology? People like me and you. Brown people are creating this technology. Then you bring in the H1 angle. Then you bring in the immigration angle into it. It creates a situation. Then who are you firing? Who do you want here? What do you want? It creates a lot of noise around it.
That we can discuss in our next week's episode, part 2, where we can highlight the immigration part. Illegal immigrants, immigrants who are legally here, and then H1B, what kind of restrictions are coming and everything. That definitely we can cover in the second part.
And we can talk about the tax compliance for each type of segment.
Yeah, let's do that next week.
People who are here on certain visas and people who are green card and US citizen, and the tax compliance that they need to be considering.
All right. With that note, we come to an end. But before that, I want to ask AJ one question. AJ, whatever the policies President Donald Trump has put on when it comes to tariff on certain countries, whatever the percentage is, 10 to 15 to 25 to 50, you think that is going to last a year or two?
I hope not. I don't know if
me
it's going
too.
to
I don't
last
think it's
or
going to
not.
last. Yeah.
I sincerely hope not. But who am I to say if it's going to last or not? There is a lot of friction around it. There is a lot of pushback around it. I hope this situation gets sorted out sooner than later.
I think, in my opinion, next November, is a big election, midterm election, what they call it, 2026, right? The voters in America will vote, will give their view, and then you will see the change coming up. So maybe a year and a half, we may have to feel the pinch, but I believe this will be all reversed, and I really hope so. AJ, thank you so very much for your time.
Thank you.
All right, folks, Tax Talk with AJ, we come to an end of it, and second part, I was going to say tomorrow, but not tomorrow. Next week, we're going to look into immigration angle. Thank you so very much for watching the Tax Talk. Until we meet again, same place, same time, I am Sanjeev Pandya, wishing you all happy tax-free days ahead, but think about tariff and just stay calm. All right? Thank you.
Thank you.
Namaskar viewers, I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ right here on ITV Gold. The show is sponsored by Sai CPA Services, a complete professional full-fledged accounting firm, multiple locations in state of New Jersey. They can assist you with your personal tax matters as well as corporate tax matters as well. Give them a call at 908-888-8900. That's a 908-888-8900. You can visit their website, saicpaservices.com. And folks, even though the tax season officially is over because we are now into almost second to third week of October 2025. So tax deadline was October 15. I hope that whoever filed the extension took care of the whatever your responsibility was October 15. But now it is still a good time to contact CPA at Sai CPA Services because this is the time between now and December you can park your money in one of those plans where you can save your tax liability. It's not that you're going to get more refund, but you can save your tax liability because those plans allow you to park your money, invest your money into it, and that will reduce your tax liability. And especially if you're in a high-end income bracket, you should really do that. And Sai CPA Services and their experts can definitely assist you with that matter. So don't think that you don't need to call CPA till January. This is the time to get in touch with CPA to have them review your 2025 tax return to see that how much money can you save when you file the tax return next year and what are the deductions you can get. So take my advice. It's a genuine advice. Give them a call at 908-888-8900. With that note, I'd like to welcome Mr. AJ Kumar of Sai CPA Services. He is a CPA, CVA, and MBA with over 25 years of experience, brings a wealth of knowledge, not only in accounting, not only in finance, but business as well. And that's why we bring this show for your information. It's a tax talk with AJ, and here is AJ. Sir, good to have you.
Thank you, Sanjay. Thank you for the kind introduction.
Absolutely. I mean it and I say it, and it is absolutely true because, obviously we need to inform, educate our viewers, and if we can make a difference into their life and if we can give them a hope, it's fine because many people are unaware. They think now, till next year, till year 2026, I don't need to do anything with the taxes. And then many of them, as you know, AJ, from your own experience, many of them, they say, oh, we are sorry, we didn't know that we could have invested money in November, December to take advantage of the tax savings. So that's why we really need to let them know.
You said it well, Sanjeev. There are a lot of people who come to us during the tax season, February, March, and how do I do?
Yes.
What can I do to save taxes? And we tell them that you could have done something before the year end. This is the time of the year, between October 15th till December 31st, we do a lot of tax planning.
Exactly.
Especially if you are in higher income tax bracket, if you are making more than six figures, more than $100,000, you must have a conversation with your accountant to see what can be done now. Can you open up another business? Do you have multiple businesses that you are not using that you can close down before the year end? So you don't have to do the tax filing for the next year. Can you invest into 401k? And remember, you cannot invest into 401k after December 31st.
Correct.
It has to be done prior to year end.
Yep.
There are a lot of tax planning that can only be done prior to year end. When it comes to Section 179 deduction, when it comes to bonus depreciation, all that has to happen prior to year end.
All
so
right.
Make sure you have a conversation with your CPA.
Very good. And that's why you need to contact Sai CPA Services, 908-888-8900, or visit their website, saicpaservices.com. Having said that, folks, last week, our last episode was on a tariff issue, Trump's tariff, and that was the part one, because at the conclusion, we said that we'll bring in a part two in the next episode. That means in this episode, we're going to touch upon some of the issues that we missed out in the last week's episode, and that we said that it's a part two on a Trump's tariff. All right, AJ, so as we discussed, Trump's tariff issue at length last week, there are a couple of things that we really missed out on it, and I really want to touch base upon it. Even though tariff issue is really, really still hot, and President Donald Trump is making some comments here and there, it definitely affects the stock market. A couple of days ago, he just mentioned that he was going to raise a tariff to China of 100%, and that really, really made stock market go down historically. So these are the things that he continues to do. He does it. But AJ, from the very business point of view, why is Trump? Why tariffs? What's the main reason behind this?
Well, if you take a step back, there are several reasons for tariff, in my opinion. Again, President Trump is higher educated, much more experienced, and has a team of people who are deciding these things for him. But the way I see it, higher the tariff, people get discouraged to buy, to import material from outside the country. So in the long run, not in the short run, in the long run, some of this stuff, some of this manufacturing will move to domestic section.
Yes.
Let's say, for example, if atta flour is expensive to bring from India, people will start eating tortillas, not immediately, in the long run. So some of these things will move. I mean, it's a crude example. Second, tariff brings a lot of money to the US government. Some of this money can be used to reduce taxes. So when we talk about President Trump reduced the taxes from 39.6% to 37%. Now QBI deduction has been made permanent. A lot of charitable contributions are above the line from next year. There are a lot of benefits. SALT deduction has been increased from 10% to 10,000 to 40,000 if you are making less than $500,000. So if you take a close look at this OBB one big beautiful bill, it's going to cost almost $4 trillion. Where is this money going to come from? So it's a zero-sum game. You have to run the government. The money has to come from somewhere. So tariff is a source of revenue for the government. In theory, if enough money can be generated through tariffs, through Trump card, through other resources, we don't have to have taxes in this country. I mean, in the initial days, President Trump said he wants to eliminate IRS and wants to have ERS. Instead of Internal Revenue Services, IRS, he wanted to have External Revenue Service, ERS. I think tariff is part of ERS planning. So I'm sure it's a thought-through plan. There are a lot of complaints around it, including me. Nobody wants to pay 50% extra. When it comes to India, tariff is 50%. I mean, it's absurd. You can't have 50% tariff on the food items. We can't avoid not eating those food items. So 50% is absurd high, and everybody is complaining about it. Nobody is liking it. But I think there is a bigger plan in picture.
Okay. Well, if there's a bigger planning in the future, as Donald Trump said that he really wants to have manufacturing here in the U.S. and everything else. Now, President Trump is 4 years, right? It's not going to happen overnight that the factories and companies are going to set up and they're going to start manufacturing. You know, you used the one example, atta flour and everything else, or many other things, right? Immediately, U.S. is not going to be able to get into manufacturing that soon and start manufacturing. And then eventually, as per Donald Trump, he's saying that U.S. should rely only on a U.S.-made products in everything, A to Z, whatever we use in our daily lives. That's not going to happen overnight. That hasn't happened in decades.
That's in theory. That's a 100-year plan. If things keeps going the way they are going, probably, and that too, probably in a lot of years, in 100 years, we'll get to that point. But you're very well said. The problem is the presidency is only 4 years, limited time. Even in this 4 year, I'm not expecting the manufacturing, forget about 100%. Manufacturing cannot be moved from one country to another country in 4 years. It takes a lot of planning around it, a lot of investment. And it's not easy, because if you're trying to manufacture anything in this country, it's not going to be cost savvy. It's not going to be cost effective. It's at least in the short term. Yep. Even with 50% tariff, bringing stuff from India is going to be cheaper than manufacturing it in US.
Absolutely.
So how do you avoid it? And that too, you have to make it all happen in 4 years.
All right. So now, as the tariff issue is definitely uncertain issue, because you never know what's going to happen tomorrow or day after or even 6 months later or next year. AJ, I have one question for you now. How do you see tariff with the tax? Meaning, what kind of implications are going to be on the taxes because of this tariff, and especially what you what you're going to be seeing in this year's tax return when the taxpayers will be filing it next year?
At least in theory, tariff should help reduce the taxes. And if tariff plan works out and get stabilized over next few months, it can create a situation when you have enough money in US government funds. Not only our debt structure will be better, our debt will go down. US government can fund more projects and can give more incentive where needed. I mean, if you look at this one big beautiful bill, it's giving away a lot of money for small income people and for large income people as well. But again, it's not sustainable if you cannot fund it. You have to find a source to fund this type of bill. So in the long run, tariff can create a situation when a lot of tax initiatives, a lot of other domestic initiatives can be funded.
Okay. All right. Quickly, before we go into a break, AJ, we have a little less than 2 minutes, so you and I are going to split some time. We're just going to go over through 2025 tariffs and tax implications. This is prepared by Sai CPA Services. So I'm just going to pick on one or two items. You also pick on the important item. One is that it's a fact that tariff could raise $5.2 trillion over 10 years. All right.
Which is more than the deficit created by the one big beautiful bill.
Yep. All right. The other one important note is business boost. Domestic manufacturers get a 15% corporate tax rate, which is also interesting.
Which is not implemented yet.
This is in a plan. This is the tariffs and tax implications. Implications are in a way of saying it that expected. Right. That's in the plan. So this is all in. Nothing is final. Inflation risk. Tariffs could raise cost and slow economic growth. This is one of the negative sides of it. We're just touching base upon the highlight of it. All right. Trade tensions. Tariffs on 57 countries spark retaliation.
It can. It already did. In the long run, it's going to stabilize. It's going to settle down. If you take a step back, all these countries have been putting tariff on U.S. export. So U.S. export and import are not balanced right now. So when we start with 50%, and let's say hypothetically it settles down at 10%. 15%. Even then, it's a huge win for the U.S. government. It's a huge win for the U.S. government to have a lot of money. 10% will turn out to be billions of dollars.
Okay. And the last thing I want to mention before we go in a break, this tariffs and tax implications is that big picture, overall, big picture of this tariffs may reshape federal funding opportunity versus risk. Ladies and gentlemen, these are the tariffs issues, related topics, and the pointers prepared by Sai CPA Services and AJ Kumar that we brought it to your attention. We're going to take a break. When we come back after the break, we're going to talk about small businesses. In our community, many businesses are called small businesses. So a lot more information coming your way right after these messages. Welcome back to the second half of the Tax Talk Show right here on ITV Gold. This weekly show gives you all the updates, information that you really need to know when it comes to taxes. But not only taxes related matters as well. Of course, business is one of them. Business and a tariff goes together. So businesses, tariffs, economy, stock market, investment, related, all these matters where taxes matter. That's what we discuss in our show. And AJ Kumar of Sai CPA Services brings his knowledge and guidance and shares it with us in this show. The show is brought to you by Sai CPA Services. Now we're going to discuss, in this part, we're going to discuss about small businesses. And AJ has a lot more information on the small businesses. Now, when it comes to small businesses, the important part to know is the tax planning for small businesses. You may have a company set up, whatever, LLC, C Corporation, S Corporation, depending upon your choice, that's a different thing. But the tax planning is a key thing, and tax planning should begin now, between now and December, so that way it benefits you next year. So AJ, let's start with the tax planning and important matters.
Absolutely, Sanjeevji. So the way we see it, this is the year of change. A lot of things are in flux. One big beautiful bill is here. There are a lot of things you can do before the year end to make a difference to your tax liability. If you own a small business, see what type of business you have. Do you have an LLC, S Corp, C Corp? Now, one big beautiful bill has made the QBI as permanent deduction. So first 20% of your profit is not taxable. This law was supposed to expire at the end of 2025. If you remember, the law was initially passed in 2017 with Tax Cut and Jobs Act for 8 years and was supposed to expire in 2025. Now that section has been made permanent. So if you have been thinking about converting your company from S Corp or LLC to C Corp, maybe you don't have to. So take a second look at it. C Corp taxes are still at 21% flat. They used to be 35%. There further talks about reducing the corporate taxes for at least domestic production to 15%, which is not a law yet, but 21% is much better than 35% what it used to be. So there are a lot of sections around it. If you are buying machinery, please try to buy it before December 31st, and it has to be put in use. You have to start using it before December 31st in order to qualify for bonus depreciation. Bonus depreciation can create amazing benefit. The best thing, bonus depreciation can create losses for the business. What it means is, if you recall, Section 179 depreciation, it was limited, cannot be more than the income. If you have a small business, and let's say the income is $10,000, your depreciation under Section 179 could not be more than $10,000. It was limited to the amount of net income you have, taxable income you have. But in bonus depreciation, you did not even pay. You buy a machinery for $40,000. On installment plan, you only paid $4,000. The benefit you get is for $40,000 deduction, and it can create losses. Even if you don't have $40,000 of net income, you can still claim bonus depreciation. A lot of things are changing, Sanjeevji, this year.
Absolutely. You just touched base upon Section 179, right? Section 179, can you share the limit up to how much millions of dollars that they can?
Yes, Section 179 deduction is limited to $2.5 million.
Right.
But please, for small businesses, $2.5 million is a lot of money. For small businesses, instead of worrying about the limit, please try to buy this stuff and try to put it in use before the year end. A lot of people will come to us at the end of the year, after the year end, when we are doing the taxes in February, March, and say, how do I reduce taxes? And I said, this question should have been asked before the year end. This question should have been asked prior to December 31st. So between October 15th, which is the tax deadline after the extension, till December 31st, all the accountants of the world, all the CPAs are only doing tax planning. So if you have a small business, more money you have, more important it is for you to do the tax planning. If you have a small business, LLC, S Corp, C Corp, whatever your business structure is, if you own real estate, let's take a step back. Maybe cost segregation study would make sense this year. But how do you know? You have to look at the tax angle. How much the tax is? If you are losing money in the stock market, well, let's do the tax loss harvesting. There is tax angle to everything. But on us, the responsibility remains on you to look into it.
Absolutely.
So please find some time, and you can save some money around.
This is a very, very important message for small businesses. You can save so much money, but you need to start planning right now. And Sai CPA Services, just a phone call away. They're experienced and knowledgeable CPAs, and even AJ himself can definitely set up an appointment with you and sit down with you and go over through details. Speaking of go over through details, how about education benefits for small business?
Amazing. People have heard about Section 529. Where people can invest money for their own kids, and then the growth is not taxable. But how about Section 127? Forget about 529. Let's talk about Section 127. This is a new thing. Small businesses can pay up to $5,250 under Section 127 for each employee. And this is not taxable to the employee, and it's tax deductible for the business.
Wow.
So it's double benefit. So if you have your employees who are going through schooling, continuing education, especially in professional world, accountants, attorneys, doctors, they have this continuing education requirement. The business can pay for this continuing education, can claim it as a deduction on the business tax return, and it's not taxable income for the the employees.
That is a simply amazing benefit, and a small business should definitely take an advantage of it. AJ, when there's a small business, let's say there's a small manufacturing company and everything, and they set up a business. Obviously, they also have R&D department, research and development department. The U.S. government Treasury also offers a benefit to R&D portion, right?
Absolutely. So there are two types of benefit. If you have domestic R&D, it's beautiful. You can claim up to $2 million of R&D expenses immediately. Immediately you can expense it. You don't have to put it on the balance sheet. It becomes an expense directly. If you have foreign R&D expenses, they have to be amortized over 15 years. But the idea is we want you to have R&D expenses in this country. If you are hiring more people, if you're trying to develop something, if you're trying to make something new, something better, that's R&D. All of that is claimable expenses immediately in the year of expense.
All right, AJ, as we are talking about these benefits for the small businesses, tax planning for small businesses, all right, this year, so that way they can take advantage of this, the deductions and everything else in the tax return. What about owner's compensation? Is there a benefit to that?
Absolutely, Sanjeevji. So there are a lot of benefits around having higher owner's compensation. The problem is a lot of people want to have lowest compensation possible to save on payroll taxes. But if you have a small business, consider defined benefit plan or defined contribution plan, solo 401k plan. You can put up to $70,000 into SCP plan into your own retirement account and count it as tax deductible. So there are a lot of benefits if you do it right. Please explore it. If you have a small business, all these retirement accounts are only applicable for a small business. I mean, if you don't have a small business, then you are not allowed to do a lot of SCP, 401k, all those plans. You can still do IRA, but then you are limited to certain compensation benefits around it.
All right. AJ, 2 minutes to go into the show, and two very important topic, 1 minute for each. 1099 changes for this year.
So 1099 for 2025, meaning the taxes that will file in 2026 for the year 2025, still has the same limit of $600. It's going to increase next year. 1099 is typically issued to LLC, individuals, and attorneys. You asked me why attorneys are specified separately. This is how the rule is saying. If you paid more than $600 in your regular course of business to an individual, LLC, or an attorney, you need to issue a 1099 to them. If you don't have a business, if you have a babysitter coming to your home, you are not required to issue a 1099. So for individuals, for your personal, you don't need to issue a 1099. For small businesses, it's extremely important to issue a 1099. The limit remains same as in prior years, at least for this year, which is $600.
Next year, $2,000.
Next year from 2026, the taxes that we'll be filing in 2027, the limit increases to $2,000 from $600.
Would it hurt the businesses? That's one.
Well, actually, it should help businesses. If they are issuing 100 1099s now, they will end up issuing 20 1099, meaning if they are paying somebody between $600 to $2,000, they don't have to issue a 1099. I mean, issuing a 1099 is a process. It has a cost around it. So small businesses wouldn't have to do that because the limit has been increased from $600 to $2,000.
Okay, all right. Last point, quickly. EBITDA. How does EBITDA help with the tax filing for small business?
So under the OBBA, what used to be EBIT, income before interest and tax, for the interest deduction has been increased to EBITDA. So now EBIT, income before interest and tax, has been changed to income before interest, tax, depreciation, and amortization. So in theory, more interest can be deducted from your small business. This is applicable only if you have large interest, large loans, highly leveraged business, and you are making more than 25 million in revenue. So if you have a business, 25 million or more in revenue, and is highly leveraged, meaning you are paying a lot of interest expense, in that case, you have to understand the difference between EBIT and EBITDA limitation on interest deduction.
Okay, very well. So we touched base upon this, tax implication issues, tax planning issues rather for the small businesses in this part of the show, this second segment of the show. In case if you missed the first segment, we touched base upon tariff issue part 2 because we did tariff part 1 last week and we did tariff part 2 in the first half of the show. In case if you missed any of it, you can just go to YouTube, just type in the Tax Talk ITV and you should be able to watch it to get all the information that you really need to know. AJ, thank you so very much for your time and guidance once again. And I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. Diwali is around the corner. You'll be celebrating Diwali. So wishing you all a very, very happy Diwali to you and your family. And we'll see you again next week, same place, same time, right here on ITV Gold. AJ, happy Diwali to you.
Happy Diwali, sir, and happy Diwali to you too.
Very good. Thank you so very much. So long. Hello, Namaskar viewers. I am Sanjeev Pandya and it is so good to be back with you with your favorite show as we are now into the year 2025. That means it's time to talk about the taxes. I know that you don't want to hear about taxes, but taxes are taxes. We all have to pay the taxes, and this is the show that Tax Talk brings you all the latest that you really need to know for your personal and corporate income taxes. You've been very supportive and you've been watching the show since last 3 seasons. So thank you so very much, and we are now here for season 4 episode number 1, the Tax Talk with AJ, the show brought to you by Sai CPA Services, a full-fledged professional accounting firm located in the state of New Jersey, multiple locations, but they can help you wherever you are in the United States of America. Their knowledgeable professional staff, CPAs on hand, can assist you with any tax matter. For an appointment, you can give them a call at 908-380-6876. And if you are one of the first ones who are watching this show on your favorite TV channel, ITV Gold, my suggestion is to visit their website, saicpaservices.com. With that note, let's begin the first episode of this season 4. And I'd like to welcome the CPA and MBA with Sai CPA Services for almost 25 years, one and only Mr. AJ Kumar. AJ, how are you?
I'm great.
Good to see you.
Oh, glad to be back. It's 4th season. We are looking forward to a wonderful season, and we have a lot of information with the new administration.
Yes.
Sanjeev ji, we are expecting a lot of changes this year. So this is the year you want to stay tuned with this show.
Absolutely. You know, for us, it's like we're dragging ourselves into the tax season, but AJ is all excited from January 2nd, 2025 to work on everyone's taxes, to help them out with all the information they really need to know, because taxes do get complicated and require a very, very professional advice and consultation. And Mr. AJ Kumar and Sai CPA Services can definitely help you out. I'd like to add one more thing. In case if you are in the middle of IRS tax audit, or if you have the tax audit matter pending since last year or 2, please take care of it right now. And if you're confused what to do contact Sai CPA Services. You will see their number on the screen. All right, AJ, as we begin our first episode for season 4, let's talk about the taxes that we're going to be filing. We're going to be filing 2024 taxes. So let's just go over 2024, a little bit of overview of 2024 limits and everything. And then in the second half, we'll touch base upon 2025.
Absolutely, Sanjeev ji. So let's start with the tax deadlines first. What are the tax deadlines? So remember, business tax deadline, LLC, S Corp files taxes 1 month sooner. So for LLC and S Corp, multi-member LLC and S Corp, the tax filing deadline is March 15th. For C Corp, personal taxes, single member LLC, the tax filing deadline is April 15th. You have an option to file the extension for 6 months. In that case, for LLC, multi-member LLC and S Corp, the tax deadline will be September 15th. And for C Corp and personal taxes, the tax deadline will be October 15th. Please remember, the extension is for filing the taxes, not for making the tax payment. So if you owe taxes and you're filing an extension, you're expected to make the tax payment along with the extension filing. Several states, including New Jersey, can deny your extension filing if you don't make proper estimated tax payments. So extension filing, remember the deadline.
Yes, that is the most important thing. All right, so now let's start with AGI, adjustable gross income. That is the first thing we're going to start with 2024 limits.
Absolutely. So now you have your W-2s. If you have businesses, you want to file your business taxes first, especially when they are flow-through businesses, multi-member LLC, S corporation. So you know how much income you got from there. That income gets added to your W-2 income, interest income, dividend income, and the business income. To get to AGI, adjusted gross income is a function of total income, gross income, and then certain adjustments, certain expenses, including half of the self-employment taxes to reach to the AGI. After AGI, you have standard deduction, and then you get to the taxable income. And that's where the income tax brackets are calculated. Remember, the income tax bracket for the year 2024, for the taxes that we'll be filing now, it starts from 10% and goes up to 37% as far as the IRS is concerned.
Okay. All right. So after AGI, obviously non-cash contributions, and let's talk about qualified charitable contributions.
Absolutely. Let's talk about the charitable contributions here. So you can contribute to any charity. If you are doing the cash contribution, you can contribute up to 60% of your AGI. That's a lot of money. If you are doing non-cash contribution, it varies from 20% to 50% depending on the type of asset you are contributing. What if your income or the situation creates that you cannot use the full charitable contribution? What if you are contributing $1 million and your income is only 200,000? You have some stocks gain and you're giving it to charity. Remember, you have the right to carry forward. So this year you can deduct only up to 60%. But whatever the unused portion of your charitable contribution is, you can take it forward for next 5 years. So you don't really typically lose anything around it. But the limits are 60% of your AGI. If your AGI is 100,000, you can donate, give to charitable contribution up to $60,000 in this example.
Okay, is there a dollar limit that makes it easy for our viewers to understand?
There is typically not a dollar limit. It depends on the AGI.
Okay.
When it comes to the charitable contribution,
just a 60% of AGI flat.
60% of the AGI is the typical formula for the cash contributions type of formula.
All right.
If you have non-cash deduction, then it depends from 20% to 50% when it comes to charities.
Okay. So now on a lighter note, let's begin with W-2s. Everyone should get W-2s latest by January 31st, 2025.
The W-2 should be mailed out by January 31st. So the system does not guarantee that the people will receive it as such, and that's why they have another 2 weeks till February 15th for mailing delays and everything. But all W-2s should be mailed out by January 31st.
Okay, 1099s.
So 1099s are meant for small businesses when you are making payments to contractors, consultant for ad hoc work, not the employees. Those 1099s should be issued latest by January 31st. So all 1099s should be issued to the proper social security number. You're not supposed to issue the 1099 on ITIN number. If your number starts with 9, it's not a social security number, it's an ITIN number, individual tax identification number. You're not legally authorized to work in this country. In that case, you should not be getting a W-2 and or a 1099. So just remember that, don't make that mistake.
Okay, very good, thank you. So now, talked about W-2s and 1099s. Now, last season, when we were just winding up after the tax season, and we used to give, basically you used to give advice and everything else. And I remember that we talked in a detail that if anybody wanted to invest money into any of the profit sharing plan or something to reduce their tax liability, obviously it had to be done before December 31st, but without waiting till the last minute, it would have been nice if it was done by December. Having said that, whatever is done, it's done. So now let's touch base upon the 401k limits for this year.
You're right. All the 401k contributions pass through the W-2. And since your W-2 is a picture that reflects your total pay till December 31st, all 401k contributions must be done prior to December 31st. But then there are certain retirement plans which you can contribute in up until late date. Let's say, for example, SEP, Simplified Employee Pension Plan, you can contribute up to March 15th. Talk about IRA, and this could be Roth IRA, traditional IRA, you can contribute till April 15th. So 401k is a plan where the contribution must happen before December 31st, and the last year's limit was about $23,000. In 2025, the limit is $23,500, assuming you are under 50. Then there's a catch-up contribution about $7,000. But 401k must be contributed as part of your employer W-2. You cannot choose to contribute yourself unless the employer, unless your the job is providing the 401k benefit.
All right. So 401k is done, IRA is done, catch-up contributions done.
Absolutely. And SCP, very, very common for small businesses. That's typically done before March 15th. Meaning there are certain retirement plans that you can still choose to do after the December 31st deadline.
All right. Now let's touch base upon another very important issue that many of our viewers really like to know, get more information on it. Capital gains and capital loss.
Absolutely, especially at this time of the year, capital gains are hot. Some people made absurd amount of money into digital currency. That's capital gain. Some people sold a lot of assets and then now they are sitting on large amount of income. The typical question we are asked, how much taxes we have to pay on capital gain. So the capital gains can be of two types, long-term capital gain and short-term capital gain. Long-term means you held the asset for more than 1 year. You bought the asset, you sold the asset, and the difference between the buying date and the selling date is at least 1 year, more than 1 year. In that case, it's a long-term capital gain, and the long-term capital gain rates are 0% depending on how much income you have, 15% or 20%. Long-term capital gain tax rate is 20%. The short-term again meaning you bought the asset, flipped it, fix and flip houses typically are short-term asset, where you bought the property and sold the property within 1 year. The income tax rate are regular income tax rate, again 10% to 37%. So short-term 10% to 37% depending on how much income you have. Long-term 0% to 20%, again depending on how much income you have.
But it is advisable if you can hold on to that capital gain for a long term, wait for 1 year, 12 months plus, right? It's advisable because you can
100%.
save substantial amount of taxes.
Especially if you don't have a need or if you don't substantially lose the value, it's always a good idea to pay half the taxes that what you have to.
Correct.
Imagine 37% versus 20%. Just remember, if you are not able to use all the capital losses, you have the right to carry forward them to the next year or the years in the future.
There you go.
Meaning
Quickly.
the maximum capital loss that you can claim in this year or in any year is 3,000 plus the capital gain.
Okay, so 3,000, that's what I wanted
That's
to...
the maximum, right?
Yeah, exactly. I wanted you to quickly touch on that capital loss, 3,000 maximum, before we go into the break. With that note, we're going to take a short break. When we come back, we're going to look into 2025 limits for you to know when you file your taxes. Once again, this is the Tax Talk, Season 4, Episode number 1. Please stay with us. Welcome back to the second half of the Tax Talk with AJ right here on ITV Gold. Folks, this is the Season 4. Familiar faces are back with you because of your popular demand. We are back. We're back here so that way we can get AJ's advice and consultation and of course his knowledge that he shares with us when it comes to taxes, personal taxes, corporate taxes, and for any taxes matter, not only taxes but bookkeeping, payroll services, or even if you need virtual CEO, CFO, Sai CPA services, a unique CPA firm in its own term here in the USA and especially for South Asian community can assist you with any tax matter. No question is a small question, no question is a silly question. Give them a call at 908-380-6876. We touched upon 2024 tax limits and AGI and capital losses and everything. Now let's get into some serious things. First, start with home office deductions because this deduction became very popular, very handy in the last couple of years, and people are working from home. So, what are the home office deduction limits and the things to know?
Absolutely, Sanjeev. Yes, after the COVID year, home office expenses became extremely important that everybody is trying to use. Before I tell you what's deductible, let me tell you what's not deductible. If you have a W-2 job, your home office expenses, your travel expenses are not deductible expenses. You have to have a legitimate formal business structure to claim the home office expenses. The good thing is you don't have to have profit in the business. You don't even have to have revenue. You don't even have to have sales in the business. As long as you have intent to make money, you have a formalized structure, LLC, S Corp, C Corp, whatever structure you have the right to claim home office expenses. A lot of times you can measure the area. This is my exclusive home office, 500 square feet. My whole house is 1500 square feet. So 33% is the home office. Or you can use a standardized method where you are allowed $5 per square feet up to 300 square feet. So home office expense is a great deduction that you should consider, especially if you have a small business.
Okay, and then good to know these limits. That means if you go to buy lunch or if you run some errands during your working hours while you take home office deduction in your tax return, it's not deductible, right? The travel expense.
If you are buying lunch for a potential client, you can claim their share of the lunch as a business expense. But if you are buying lunch and or coffee for yourself, that's really not a business expense. So you have to be careful when you go into home office expense area, meals and entertainment area. That's what's kosher. And the rule of thumb is what expense you wouldn't have had if you did not have the business. Say, for example, if you had to pay the CPA to form the business. If you did not have the business, you did not have to pay the CPA. So that's a business expense. But you would have eaten anyway. You would have had the coffee anyway. So the expenses that you would have had anyway that are not dependent on this business are typically not the business expenses.
All right, now let's go into one of the very, very relevant topics for South Asian community, which is FBAR.
Absolutely. A lot of people, as you rightly said, we all come from a foreign country. If we did not come from a foreign country, our parents came from foreign country. So we are all immigrants in this country, and that's when FBAR and FATCA, foreign bank account reporting and foreign asset reporting, becomes extremely important. So in a nutshell, the rules are for FBAR, if you had more than $10,000 at any given point of time in all your bank accounts combined together, you have FBAR filing obligation. If you have FBAR filing obligation, you need to report all the bank accounts you had in a foreign country and the maximum amount you had in that account. Take an example quickly. Let's say you are buying a property in India. You transferred some money from US to India. For one day, the money stayed in your account, $100,000. And then this money went to the dealership. But for one day, you had $100,000. You have a couple of other accounts where you had $1,000, $2,000, $3,000. But just because for one day, at any point of time, just for one day, you had more than $10,000 in a foreign account, it triggered the FBAR filing requirement. Now, not only you have to report this account where you had $100,000, and we always report the maximum amount, you have to report all other accounts and the maximum amount that you had in those accounts at any point of time. That's FBAR in a nutshell. Looking at FATCA, where we say foreign asset reporting, this is more about if you have property. A lot of people have paternal properties or bought the houses or some shops in India, inherited some properties, land. You're supposed to report it if the property value is more than $50,000 at any point of time for a single filer or $100,000 for a married filing joint tax return. So if your property value, give or take, based on today's rate, is more than 85 lakh rupees at the end of the year, or about 150,000, about 1.25 crore rupees at any point of time during the year, for a married filing joint tax return, that's when the FATCA is triggered, and now you're supposed to report all the assets, even if you're not earning anything. It's not about the income tax. It's about asset reporting. So if you have a farmland, if you have a just open land, there is no rental income, but it's worth 2 crore rupees, you are still supposed to report it. That's FATCA for you.
That's about the rental income. But anyway, FBAR, FATCA, and the rental income we just covered. You know, folks, I just want to let you know that this is just the beginning of the tax season. So these numbers and all the details may confuse you or may put you into some kind of thinking mode, but that's where Sai CPA service is for you. So give them a call at 908-380-6876. You will see the number on the screen, and they will help you with any tax matters.
I'll also remind Sanjeevji that we will have a separate show on FBAR and FATCA only. You can also go to Sai CPA Services YouTube video channel, and we have a show just on FBAR and FATCA over there.
Yes, absolutely. You always give age a lot of information on FBAR, so that's always helpful. Now let's look into the rental income, because folks made good amount of money in the last year, and then they invested buying a property and they rented it out. So now let's look into the rental income and expenses. How does that work?
Absolutely. So before I tell you the rental income and expense section, I want to remind everybody that rental income and expenses are taxable transactions even if they are outside this country. If you have a rental property in India, you should still report that property on your tax return in US. Even if you are filing taxes in India, you should still report that property. The taxes that you paid in India can become an offset to the tax liability over here. But the key here is that you should report that transaction on the US tax return. So you have rental income, you may have some cleaning expenses, some tenant finding expenses, mortgage interest, property tax, travel, professional fees. Depreciation is a big expense when it comes to rental properties. So after taking out all the expenses, you look at the net, and please, unless you are a realtor or unless you have a lot of properties and you're investing at least 1,000 hours into this business, into this rental business, rental property business is supposed to be passive business for you. Don't make that mistake. A lot of audits happen on rental income side because people tried to claim losses as an active losses. The losses from the rental property should be suspended and should be used in the year when you have rental profit or when you dispose of the property. A lot of people make this mistake when they try to claim the rental property as active business, and that's how they get audited.
All right. Okay. So with that note, passive activity rules, anything that you like to touch upon that?
Absolutely. So the main difference, I mean, you have to show that this is your main business. That's the active business means. So IRS has certain rules around it. If you have 1,000 hours into this type of business, and how do you have 1,000 hours? You could be a realtor, you could be a real estate professional, or you have 10 properties or a bunch of properties that you are managing and you don't have any other job. That's how you justify, this is my main business, this is my active business. But if you have a W-2, if you have other business and rental properties on the side, then it's hard to justify that you spent 1,000 hours on this business. So from that perspective, a lot of rental business by definition, by default, is considered as passive business.
Okay, very well. As we are closely approaching the show limit, the time limit, let's talk about quickly tax implications and inheritances.
Absolutely. So the key with the inheritance, and I want to differentiate when it comes to inheritance versus gifting. The question we are typically asked, my parents are old, can I have them gift the house to me? And the main difference when it comes to gifting versus inheritance. Inheritance means the property came to the next generation because the parents passed away. That's the inheritance. So when you gift something to somebody, their cost basis remains the same. Let's say if your father purchased the property for $100,000. Now the property value is $500,000. If the parents gift this property to their children, the children's cost basis will be 100,000. So if they sell it tomorrow for 500, they have to pay tax on 400,000. If the children gets this property through inheritance, their cost basis is the market value. Then you don't have to pay any capital gain taxes. So if you have an option, prefer inheritance over gifting. I mean, if you don't have an option, it is what it is. But inheritance, the key we want to explain here, brings the cost basis as the market value, not the purchased value.
All right. Now, I just want to make sure that these things, the inheritance and taxes and everything else applies for the properties here in the USA also, not necessarily only properties in the country that you come from, right?
All of them.
All of
we
them.
don't differentiate where the property is located.
All right. Quickly, now let's touch base upon estate tax.
Absolutely. So estate tax is a function of estate. Estate is created when somebody passed away. Right now, the estate tax limit, meaning you don't pay any taxes up to $13.6 million. This is the limit for 2024. For 2025, the estate tax limit is 13.9. This is per person. For husband, wife, if you do the portability filing, Form 706 filing, you can combine the two limits together. So for all practical purposes, for $28 million of net worth can be passed to the next generation without worrying about the estate taxes. We are not saying estate planning is not important. What we are saying is estate planning is not for everybody. Unless you have certain assets, few $1 million at least, you don't have to worry about the estate as such.
All right, when you talk about estate tax, let's touch base upon gift tax exclusion.
Absolutely. So gift tax limit right now is $18,000, where you don't have to pay any taxes and you don't have to do any filing. So you can give $18,000 to as many people as you want without worrying about any filing. Forget about the taxes. The person who is receiving the gift, they don't pay any taxes. The person who is giving the gift, giftor, doesn't get any deduction, and none of them do any filing as long as the total gift for the whole year is under $18,000.
Very well. Folks, with that note, we come to an end of this Season 4, Episode number 1, Tax Talk with AJ. AJ, thank you so very
Absolutely.
much. And like I say, this gets a little complicated, or it's going to take a little time for you to get into your head, and of course, piece of paper and a pen and everything else. But do give Sai CPA Services a call. They are the, with that sponsorship, the show comes in, the Tax Talk with AJ, right here on ITV Gold. You can reach Sai CPA Services by dialing 908-380-6876 or visit saicpaservices.com. Throughout this season, every week, we're going to have more and more tax-related information. And mind you, it's personal and corporate taxes, all right? So they'll be coming, hoping that you will join us every week, same place, same time. AJ, thank you so very much.
Thank you, Sanjeevji.
Thank you, and I wish you all a very happy, best, and tax-free year ahead 2025. So long.
Thank you.
Hello and namaskar viewers, I am Sanjeev Pandya welcoming you to this week's edition of the Season 4, the Tax Talk, right here on ITV Gold. Happy to be with you as we bring you all the tax related updates, changes, tax laws, kya hua, kya nahi hua. We get all the information and a guidance from a very reliable source. First of all, the show is brought to you by Sai CPA Services, a full-fledged accounting, very professional accounting firm located in the state of New Jersey with multiple locations, and they can assist you with your personal taxes, corporate taxes, taxes related matters. If you are thinking about starting your own business and you need to set up an entity and you're not sure which one to set up, Sai CPA Services and their knowledgeable and experienced on-hand CPAs can guide you and assist you in the right direction. So for any tax matter, give them a call at 908-888-8900 or visit their website saicpaservices.com. With that note, I'd like to introduce Mr. AJ Kumar, CPA and MBA with Sai CPA Services, who joins us every week, and under his guidance and directions we come to know about the taxes. AJ, good to have you in the show.
Thank you, Sanjeevji. Thank you for the kind introduction.
You're very welcome. Now we are here in almost end of January, and the tax season is really heating up, because you must have gotten your W-2s or 1099s and whatever the tax related documents you must have gotten, or they must be on the way. So now today, instead of taxes, let's talk about audit checks by IRS. Why do IRS check on the audit? What are the main reasons that IRS picks up the tax return and sees something not right? I'm not saying something wrong, but something not right. Maybe you missed something. And that's what the IRS audit check is, and there is a long list of those audit checks. So AJ will go step by step and explain to us what are the common errors that we should not make, so that way your return is not audit checked by IRS.
Absolutely, Sanjeevji. As much as we get a lot of calls how to lower the tax liability, but when it comes to taxes, it's not just about minimizing the tax liability. The last thing you want is IRS on your back. The last thing you want is something missed on your taxes. And remember, if you pay more than your fair share, IRS is not sending back a letter to you, you paid me more, here is your money. On the other hand, if you pay lesser than what you should have paid, they are happy to send you the letter. So accuracy is what's more important than minimizing the tax liability. When it comes to audit, it's a computer software. There are a lot of things this computer will automatically check and will generate a notice if things are not aligned properly. So in this episode, we'll try to highlight certain things, 10 common mistakes, 10 main things that you can be careful. So it's more about on the caution side, stay on the precautiously, what can you do now to ensure your audit probability is minimized, not just the tax liability.
Okay, very well. So let's start with the item number 1, which is round numbers. What's wrong with the round numbers?
Well, I'm glad you asked. So if you have a small business and you are reporting the income, expenses, and all are round numbers, 1,000, income 20,000, travel expense 1,000, uniform 2,000, rent 10,000, phone, internet 3,000. All these numbers feels like they are made up number. They may be right, but they feels like you don't have proper documentation around it. They feel like estimated numbers as opposed to accurate number. So the software, computer software will detect all the rounded numbers. Rent could be rounded, $1,000 a month. But think about it, can the utility bill, can the travel, can a lot of these bills really be rounded as much? And if you see everything in thousands, the computer software will generate a notice, please provide the necessary support. So having all these rounded numbers, especially on the business side, can actually generate an audit.
Okay, so these are the round numbers that one need to be very careful. Don't make it so obvious when it comes to round numbers, right?
Yeah, it's common sense.
Okay, so after the round numbers, now let's go into other things. As you know, number one thing, viewers, that you should really know that when you file a tax return and whatever the deductions you're claiming, make sure you have supported receipts to save them. You never know when IRS is going to come and ask for it. So receipts are important. The reason I'm talking about receipts because now I'm going to lead into the second point, which is a cash related business. If you are in one of those cash related businesses, there are certain things that you need to be careful.
Absolutely. I'll add to that the receipts have to be contemporaneous in nature. You cannot really say if the need be, I can get you the receipt. At the time of filing the taxes, the receipts must be there. The other thing, having the receipt only does not make it a legitimate expense. You have to have the proof of payment. Take an example. You can go to Home Depot, stand outside the Home Depot door. By the evening, you have $10,000 worth of receipt in your hands. Does it mean you have 10,000 of expense as repair and maintenance? You have to show proof of payment. How did you make that payment? Just the receipt alone is not a sufficient proof. Receipt along with the proof of payment is what makes it a legitimate expense. Here, as a second red flag, second precaution that we are talking about is the cash intensive business. We know laundromat will have cash. We know the grocery store, typical ethnic grocery store, typical ethnic restaurant, they have some cash. So if we are reporting your income tax has only the bank deposits in, it's a red flag. The system, IRS has the access, the right to collect all your bank statement. They will see how much revenue, how much gross receipt you are reporting. If your gross receipts is matching exactly with what the bank deposits are, you missed something. You did not report any cash. Especially for cash intensive business, you must add some portion. We don't really know. The system doesn't know if the cash is 5,000 or 15,000. The problem is not reporting any cash is what creates problem.
Very good, well said. Now that prompts me to ask a question. In today's digital age and the payments and everything with credit cards and Google Pay and everything else, you think there are some business are still heavily cash generated?
It's not about heavily or less cash. There are certain type of business where you know the cash is going to be there.
Okay.
There are some companies, IT consulting company, they probably don't have any cash. Especially with a lot of professionals, we are okay with not having any cash, but how do you justify having no cash on a pawn shop? How do you justify having no cash in an Indian restaurant? So some cash is a good idea. When you do the taxes, show some cash over there.
Okay, all right. So now let's go quickly to the next category. When you fill out your tax return, make sure that your income is stated correctly. missing income, in case if you miss something, it could send a red flag to IRS.
It's more than the red flag. Think about it. When the W-2 or 1099 is issued to you, a copy is submitted to the IRS.
Correct.
A copy goes to the state. So the system, the computer, the software already knows what your income should have been. So if you miss one 1099, some interest, some rental income, the system is expecting to see that income. And if that income is not there, an automatic letter is generated. We want to look at your taxes. We believe your income is understated. So making sure all your income is stated properly on the tax return is a very good idea.
Okay, very well said. So that is the income part. Now continuing with this one, everybody wants to take as many tax deductions or tax breaks possible, but you need to make sure that they don't exceed to your income, right? Don't be that silly to have your deductions higher than your income.
Well, not that it's not possible. So if you have a new business, it's possible to have more investment in the business or showing losses in the business. The problem is when you continue to show losses year after year after year, then there comes a time when you say, why are you doing it? Why don't you stop this nonsense and stop losing money? So the point is, showing losses or having expenses more than the income by itself is not a trigger, but creating a history around it, showing losses consistently year, after some time, the system will say this is not a business, this is a hobby. You are intentionally investing money because it makes you happy, not that it's a business. If it was a truly business, why would you be doing it? Why can't you stop? Why don't you just stop it? So they will say we are denying your losses because hobby losses are not tax deductible. Business losses are tax deductible, but if it was business, 1 year is okay. 2 years is okay, but how long are you going to carry this thing? So that's the trick over there. That's the problem over there.
All right, talk about trick and the problem. Foreign accounts. You may think, I don't need to do anything with foreign accounts and nobody's going to know because only I know it. However, I is going to find out, but there is a way that it can be found out. So you also need to be careful with foreign accounts.
100%. And there are several ways, several triggers the IRS will know the foreign accounts. First example, we know how much interest income you are reporting. Remember we said the 1099s are reported to the IRS, to the state. Your foreign interest, if you are showing the interest income on your Schedule B and your foreign interest is, let's say, $5,000. We know in this country, the interest rates are 2%, 3%, 4%, not more than that. If your interest income is $5,000, you must be having